Welcome back to the European Market Open. A minute to go until the start of cash equity trading. I'm Anna Edwards, live in London with Tom McKenzie.
Good morning. Price pressures. China sees the highest factory inflation in 26 years after US CPI goes above 5% once again. Earnings season ramps up. Bank of America, Morgan Stanley and Citigroup report today, and midnight dismissals. The lira slides to another record low after President Erdogan fired 3 central bankers overnight.
Let's take a look at the futures picture then, Tom, and it's buoyant, it's positive. The European futures picture pointing to the upside. The US futures picture points to the upside. As we wait for European equity markets to open up, it's almost as if we've forgotten that we're concerned around inflation. Despite the fact that oil prices are going higher, the inflation print in the US came in above 5%, and we got that 26-year high in factory gate inflation coming out of China. So it looks as if we're set for another positive start to the European trading day then, Tom.
Larry Summers is very concerned about inflation, but as you say, the markets seem to be looking through what we're seeing in terms of the data out of the US and China, both suggesting that inflation remains sticky for the moment at least. The markets here in the UK up 0.3%. Anna and Mark were discussing the oil price, the fact that WTI is above $81 currently. You're seeing rises as well for Brent and how that plays in to the basic resources sector here in the UK, currently gaining at 0.5%. Yesterday, of course, you saw technology rallying in the US. It was a strong session in Europe as well for technology. The US 10-year yield currently comfortably below that 1.6 level, so the yield story starting to give some comfort, at least for now, for technology. The earnings picture as well, firmly in focus. You had JP Morgan in terms of their M&A deals, very strong, but in terms of the loans, there was disappointment there. Here, in terms of the CAC count, you're looking at gains of 0.8%. Solid revenue there from Publicis. That's one corporate to keep an eye on in the French space. Spain as well, gaining in terms of the IBEX, 0.8%. The Italian FTSE is also in similar territory. So let's change it on and have a look at the sectors then. Yesterday, as I say, technology was leading the pack. It was financials that were at the bottom. Currently, energy gaining at 1.3%. Again, as you're seeing oil prices rise ever higher, how that plays into the inflationary picture as well. Utilities gaining 0.3%. Here in the UK, concerns and reports that other utility companies may be going to the wall as a result of these higher prices. The banking sector is gaining 0.9%. You have the likes of Citi and Wells Fargo reporting later today, as JP Morgan yesterday. Technology gaining once again, at least in the first few minutes of the trading session here in Europe, gaining more than 1%. Anna.
Okay, so we've got European equity markets then opening to the upside, as you set out there, Tom. Traders are considering further signs of global inflationary pressures. That's as US CPI rose by more than forecast in September. And in China, factory gate prices grew at the fastest pace in almost 26 years in September. Let's speak now to Valentin van Nieuwenhausen, CIO at NN Investment Partners, who joins us this morning on the European Market Open. Valentin, a very good morning to you. So does it make sense to you that we're seeing moves higher in risk assets despite all of these inflationary concerns? How do you square that?
Well, good morning, Anna. Yeah, if you look at just of the daily moves, it may be a bit surprising, but of course, you know, markets anticipate things. We've seen that with the big surprises in April and May on the inflation front, whereafter also actually market digested them quite well. I think what you're basically seeing is that we had a bout of risk aversion over the last 3-4 weeks. That's shaken out markets a little bit. We're seeing now that the conviction that at the core, supply bottlenecks and inflationary pressures will prove to be temporary is still embedded underneath in the market. So we've had a risk shakeout. As long as that conviction is not fundamentally changing, I think you will see more volatility, and after a shakeout, you will also see these days, like yesterday, like today, where you get a rebound. There's still a lot of cash there that needs to move somewhere. Bonds are not that attractive, so as soon as the fear factor moderates, you see equities moving up. And it's really waiting for the moment where markets fundamentally change their opinion about inflation, and we're not there yet.
We heard, of course, in terms of the Fed minutes, it's cementing this view that the taper will start in either November, December, and that takes many investors onto the question of the rate hike cycle. Markets pricing in a hike from the Fed by December of next year. How do you position around that?
Well, I think, again, critically important, if you look at all tapering cycles, all rate hike cycles, the period running up to the moment that this starts is often the most challenging for markets. So, you know, buying the rumors, selling the facts, anticipating future interest rates hikes or tightening of policy is where markets are shaky. Once it starts, actually, it's often also clearing a little bit the uncertainty for markets. And that might be a period where maybe if the economy continues to do well, markets get a bit more on their front foot again. So I think for the next couple of months, it's going to be more volatile, and you have these up and down days and maybe a bit more of a correction, as everybody seems to be anticipating. But once we get into actually tapering, and once we get into rate hikes, I think that markets will actually calm down a little bit more and see that the underlying economy is still doing pretty well.
There's been a lot written and a lot said about stagflation, Valentin, in recent weeks, maybe too much. You talk about stagflation light. Is that just because we can't, it's difficult to see stagflation when you have economies growing so quickly? Sure, from lows that were well telegraphed, from deep lows, and we know why that happened. Is that why it's difficult to call it stagflation at this point, because growth levels are as high as they are and household balance sheets in many places are pretty strong?
Exactly. I mean, let's not forget, let's take a step back where we're coming from, the COVID crisis, the massive, very sharp recession. Many economies are still operating below the levels they were doing before COVID or just around that level. The potential room to grow further in many economies is still there. Balance sheets are good. There's still a potential pent-up demand, both on the household side as well on the CapEx side. Also on the energy dynamics, by the way, a lot of CapEx is driven through the energy sector. So actually there might be more investment coming from that side. So all in all, I think medium term, there is still more room to grow for the economy. Stagflation from the 70s is a period where there is no growth and high inflation. What we're seeing now is a bit of a growth worry, but still anticipating solid growth going forward and somewhat higher input prices mainly, which we still remain convinced will prove to be temporary, but they will occasionally scare markets for the next 9 to 12 months.
Okay, so those growth worries, some of those are emanating from China. We see the credit impulse starting to slow. You've got all the question marks around real estate. We, of course, had that inflation, the highest level since for 26 years. We had James Athey on from Aberdeen Investments yesterday saying that investors are underestimating the potential for the slowdown in China, and particularly the impact on countries like Germany and Australia.
Well, I think there's an important point there, but it's a distinction between maybe the short-term panic related to bond issuance, illiquidity, and specifics around individual names that are at play currently for market sentiment. The long-term read-through from all this is clearly that there will be far less of a support coming for Chinese growth from the property sector. And that part of investment in China has been a key driver behind the strength in growth in China. And I think that is an important medium-term takeaway, not something for the next couple of months to drive market sentiment, but a medium-term takeaway for Chinese growth. Construction and the property sector are not going to be leading that growth for the next 3 to 5 years.
Valentin, thank you very much. Stay with us. Valentin van Nieuwenhausen, CIO at NN Investment Partners. More with him shortly. Coming up on the programme, we'll get calls and contrarian views from our guests. We'll ask him how he's trading these markets, get more into that conversation next. This is Bloomberg.
inflation really transitory, or is there a risk that because we believe it's not transitory, it actually becomes sticky?
I think central banks are really worried about inflation now. Much of what we see probably is transitory, but nevertheless, it's a lot easier to see upside risks to inflation than downside risks. None of us know where inflation will go over the next year or so, but upside risks are coming, I think, from three sources. One, as we gradually learn to live with COVID-19, the bottleneck effects are pushing up some prices. Secondly, energy prices, we've seen, even yesterday, they moved all over the place for gas prices. We don't know where they'll go, but it's much easier to see upside risks than downside risks. And third, and I think one which is very different from the past 20, 30 years, is that the political risks are also much stronger. There's real pressure now to boost public spending, but not to raise taxes to finance it.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to the European Market Open. 10 minutes into our European trading session, and as expected, as the futures had indicated, we are higher across European equity markets this morning. Let's get a look at some of the stocks on the move, though. And Tom, let's start with the mining sector. Antofagasta, a nice example of that this morning. The stock up by just over 3%, 3.3% to the upside. Base metals near an all-time high. If you look at a collection of 6 or so on the LME, it's very close to an all-time high. All part of the inflation narrative. It's been a year-long rally in metals. Add into, and that's on the demand recovery, add into that supply issues and the energy tightness, and that is adding up to higher prices for some of the things that the likes of Antofagasta make. What about advertising?
Yeah, advertising. So Publicis, of course, listed in Paris, doing well. You can see the shares there gaining close to 2.5%. So what they're saying is that, in fact, revenue is back above pre-pandemic levels. They also raised their forecasts as well, and they see organic revenue increased, in fact, 11.2% in the third quarter, and that beat average analyst forecasts. So some questions in terms of the investment around data advertising paying off for Publicis.
Let's talk about Demant. This is a Copenhagen-listed medical equipment company, and this company on the move to the downside this morning, down by 2.9%. We've seen a recall of product over at Demant. They've had to recall and temporarily halt sales of new implants. They say this is due to the identification of performance issues in a small subset of implants, and they don't have any reported safety events around the implants. So probably important to say that as we see the stock slide. Let's get back to our guest. Valentin van Nieuwenhuysen, CIO at NN Investment Partners, is still with us. We've just been through a few movers, and I wonder how you're trading these markets at this point, your sort of favoured sectors. I talked there about Antofagasta, and that sector once again to the upside, although I think just earlier on this week it was the biggest loser, so it's fairly volatile. The materials space, how do you see that playing out, Valentin, with these much higher metals prices at the moment?
Well, I think that overall, playing the markets right now, we're in a bit of a period where we're not taking the most aggressive positions until we get into the actual tapering. I think it will be staying a bit volatile. But if you want to pick certain sectors within equity space, for example, certainly materials, also financial still, because I do expect this sort of value theme to continue a bit further, are attractive. And it's not only because of the spikes that we see in gas and oil, but it is also more medium-term perspective on, let's say, industrial metals and the further upside that we see for growth in the sector, for also the role that they are playing in the energy transition, actually. So some of these commodities and the companies related to producing them remain attractive. So it's one of our favorite sectors.
Valentin, can you unpack your views on the financials then? We, of course, had JP Morgan in terms of the earnings yesterday. We've got Citi, Wells Fargo and others later today. There was some pressure around consumer loans and corporate loans from JP Morgan. Is that a concern for you at all?
Well, not materially one. I think, first of all, this is going to be one of the most interesting earnings seasons that we've had in a very long time, because it's going to be much more dispersed. It's going to be much more revealing on how, whether it's on the financial side or in other sectors, companies actually deal with these, very fascinating durations currently in the global economy. Specifically on the topic that you mentioned, we are not massively concerned, but more importantly, there obviously is the tailwind that we anticipate for financials broadly from a drift up in yields, clearly bonds not being our favorite place to be. And we do expect there further support for the sector as a whole coming from somewhat higher interest rates.
Valentin, as we head towards COP26, I'm interested in your play on carbon, your overweight carbon, the European cap and trade scheme, a focus for you. Tell us about your strategy as we head towards COP, and is it a play on COP26? Is there a specific outcome of COP26 that you're banking on?
Well, I would say it's a much bigger play than that. COP26 is an important stepping stone on a much bigger journey in terms of transforming our economic model to a more sustainable future. And the powers that start to interact around this theme only seem to be growing, and not only in Europe, but also globally more and more. And I think that transition from a European leadership role in terms of policy setting around the theme is probably important for COP26 to get it more to a global scale. But all in all, we do feel that indeed carbon will be one of the most interesting asset classes from a medium-term perspective on the back of this necessary but also very much in focus transformation that we have to undergo in the global economy, basically. And the scarcity can be used, or increased scarcity is one of the policy tools that European policymakers have. So we do play it through the European cap and trade market, where we do feel that on the back of COP26 and all the regulation coming into play in Europe over the coming years, there will be persistent upward pressure on the carbon price.
Okay, Valentin, from carbon to Dr. Copper, what underpins your positive view on that metal, particularly in light of what we're seeing around question marks on China's growth trajectory?
Yeah, very good point on China. But as I said earlier, I do think that copper, aluminum, and these type of industrial metals do play an important role in the manufacturing sector, the factory sector, but also the role that this sector plays in the energy transformation. And if you talk about China, I mentioned earlier on that I'm a bit concerned about the contribution from construction. I'm a bit more maybe concerned on the tech side in China, as we all know what's at play over there. But if you think about more solid manufacturing, tangible manufacturing, I think that complex in China will continue to get strong support and maybe even become more important than it has already been. Recently, again, we saw also strong export demand. I don't see that going away. I see that as even stronger than in the past, a central pillar for Chinese growth going forward. And as a result, I expect these types of metals to continue to be well supported.
Okay, thanks very much. Valentin.
Okay, Valentin van Nieuwenhuizen, CIO at NN Investment Partners. Okay, let's get the Bloomberg Business Flash now with Angel Feliciano.
Tom, TSMC says it will build a fabrication facility for specialty chips in Japan and plans to begin production there in late 2024. That's as the world's #1 foundry reported quarterly profit beating expectations as demand for chips stayed robust in the face of worsening supply chain problems. The Taiwanese company has set aside $100 billion to grow output over the next 3 years. Finance ministers from the world's biggest economies have endorsed a global tax overhaul. 136 governments had earlier reached a deal over a minimum rate to be set at 15% for corporations. Plans for digital taxes have also been scrapped after the U.S. said they were discriminatory. The stage is now set for G20 leaders to approve the accord at a summit later this month. Sources tell us that Amazon.com is shopping for used long-range Boeing 777s and Airbus's A330 cargo planes. More evidence of the company's ambitions to move products from countries like China by itself. The plane models are bigger than Amazon's current fleet of Boeing 767s and would see the e-commerce giant step up rivalry with UPS and FedEx. Kathy Wood is joining the slate of Wall Street players, hoping U.S. regulators will soon greenlight an ETF tracking Bitcoin futures. The new ETF plans to invest in contracts that trade on commodity exchanges. According to Bloomberg Intelligence, 9 Bitcoin futures ETF applications were being considered by regulators at the beginning of this month. And that's your Bloomberg Business Flash. Anna.
Okay, Angel, thank you very much indeed. We have some lines crossing on the terminal from Chinese Premier Li Keqiang. He's saying that he's confident that China will meet and achieve its full-year targets. A number of economists have come out and challenged whether or not, a couple have come out and challenged whether or not China will meet its target of above 6% GDP growth for this year. Others have said that they are still likely to meet it, despite the challenges around real estate, but also, of course, the energy crunch that we're seeing playing out. So he's pointing out that these supply chain challenges remain and energy challenges remain acute.
And speaking pretty confidently, saying that China will ensure electricity demand is met. And that's interesting in the context of some of the stories we've been reading recently and writing recently, suggesting that perhaps a shortage of energy at reasonable prices could weigh on the Chinese growth story. Certainly our colleague David Fickling writing something along those lines just overnight. So we'll return to that story, no doubt, but we'll watch those news lines coming through. Now, coming up on this programme, truce or trade war? The EU and UK brace for a new round of Brexit talks over trade barriers in Northern Ireland. That story is next. This is Bloomberg.
Natanggap ko po ang inyong nominasyon sa akin bilang kandidato sa pagkapangulo ng Republika ng Pilipinas. I am a fighter, and I will always be a fighter inside and outside the ring.
From New York City.
We're in London, in Sydney,
In San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims
How are
front.
you thinking about those dynamics?
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Welcome back to the Open. We are 22 minutes into the European trading day. The Stocks Europe 600 currently gaining around 0.6%. Here in the UK, gains of about 0.5%. Similar picture for the CAC 40 and in Germany as well. Top of the list in terms of sectors, you've got basic resources gaining on the back of higher energy prices. Also technology gaining 1.6% in terms of the sectors. Okay, let's switch focus to Brexit now. The European Union and the UK are braced for a new round of negotiations over trade barriers in Northern Ireland. It comes after a British challenge and fresh concessions from the bloc signalled glimmers of progress in diffusing tensions. Bloomberg's Brussels bureau chief Kevin Whitelaw joins us now. Kevin, how serious then is the EU's proposal to the UK?
Well, you know, it's interesting. The EU tried to tailor its proposal to address a lot of the practical issues that people in Northern Ireland, in particular, and businesses there had been identifying. So addressing the movement of things like medicines and customs checks, and as well as food inspections. And you know, I think the EU feels it moved quite a long way. The proposal really is a bare bones sort of version that still needs to be fleshed out. The EU saying, look, this isn't an ultimatum, it's not a take it or leave it. This is the beginning of a conversation with the UK over how exactly we implement this, and they feel they've moved really quite far. It's just not clear it's going to be far enough for the UK, given that the EU proposal doesn't address, you know, one or two of what have become sort of the key demands out of London.
Yeah, good morning to you, Kevin. Let's think about that. What stands in the way of a deal? Is it to do with the role of the ECJ then? Is that the sort of major stumbling block here still?
Yeah, so far that seems to be sort of the big outstanding one. At least that's the one that the EU did not address in the proposal that came out yesterday. Doesn't mean that there's no way out of it, but that's still sort of the ultimate. You know, so far the big sticking point. The EU says you can't really have, you know, access to the common market if at some point EU law doesn't reign supreme over it. UK is saying that they don't think that this should be, you know, that they should, you know, sort of be subject only to an EU court. That's why they left. Part of the reason they left the EU in the first place. There may well be a solution out of this, you know, creating some kind of interim body that would handle most of the actual disputes, some kind of joint mechanism. You can imagine some creative solutions. There's one or two sort of, you know, things that they could draw on that exist already for that, but we're not there yet.
Well, talk to us about the timing. Why is this all happening now, this tussle, and how much of it is it down to domestic politics here in the UK?
Yeah, I mean, I do think that, you know, certainly from the Brussels side, that's almost entirely what's happening here. I mean, you know, keep in mind the Northern Ireland Protocol, which is what governs the movement of goods in and out of Northern Ireland, that was part of the big Brexit negotiation that was only, you know, concluded only in 2019. This was signed off by both sides. No one loved the deal, but it was a deal that it was a deal that was there. And it was the deal that they finally agreed on, and so this does feel, at least from the EU side, like a bit of a sudden attempt to renegotiate it. From the UK side, I think there are some legitimate issues that have been brought up that the deal had not fully envisaged, that were actually creating real problems for Northern Ireland. I think the EU is pretty ready to deal with those. I think yesterday's offer shows that. I think the deeper philosophical things may be driven a little bit more, you know, by some of the domestic politics and a government in London that is pretty eager to be able to distract from some other issues.
Okay, thanks very much for bringing us the view from Brussels. Bloomberg's bureau chief over in Brussels, Kevin Whitelaw, thanks very much for the update. Coming up on this program, it's a big day for US bank earnings. Much of the focus will be on loan growth after JP Morgan disappointed investors on that front. What use do households have of loans when they have large deposits, at least at the aggregate level, even if not in the individual level, sitting in their bank accounts? And what do banks do with all those deposits? That's part of the big bank narrative. This is Bloomberg.
don't know what to say. Again, they can't even fathom that they're out of Afghanistan. They're still in a state of shock and can't believe it.
What we have built through this process is essentially a mechanism for getting oppressed women and girls out of Afghanistan. So we're actually going to circle up and see what resources we have left, to see what options we have left, what mechanisms we have left, and actually look at potentially trying to get more women and girls out of the country as well.
We've been through a lot, us as a team. I know sleepless nights, but you know what? There's nothing more satisfying than knowing that you've saved many lives, and will continue to support these girls on their missions.
The growth story in cannabis remains very strong, even after the sort of loosening of the pandemic. There was a worry that there might be wallet spend competition, but so far the cannabis sector seems to be holding up very strong.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Welcome back to the European Market Open. 30 minutes into our European trading day for this Thursday morning, here are your top stories. Price pressures. China sees the highest factory inflation in 26 years after US CPI prints above 5% once again. Earnings season ramps up. Bank of America, Morgan Stanley and Citigroup report today. And midnight dismissals. The lira slides to another record low after President Erdogan fired 3 central bankers overnight. So the European equity market picture then, Tom, kind of dismissing concerns around inflation today, approaching things with a different mindset, stocks to the upside. But over recent weeks, since kind of the middle of August, we do seem to have been bothered by this inflation and supply chain narrative. Not so today.
Yeah, looking through that CPI print in the US of above 5%, of course, 26-year highs we're discussing around China's PPI, the factory gate prices. There is this gap, though, between the producer prices, the factory gate prices in China, and CPI, consumer prices. So far, not a lot of that inflation is being passed on to consumers. Bloomberg Economics says that gives the PBOC, the central bank there in China, a bit of room. We heard from the Chinese Premier, Li Keqiang, just in the last few minutes, saying that the energy constraints with coal prices records in China are challenging, but he still thinks that China will meet its targets and goals for the rest of the year. The Stocks Europe 600 gaining 0.5% after eking out some modest gains yesterday. The US and stocks there, the S&P 500 snapping 3 days of losses. Technology coming back very strongly in the US session on the back of yields that seem to edge off a little bit, below at least 1.6, currently around 1.55 for the US 10-year. The DAX currently gaining 0.5%. You have Olaf Scholz from the SPD coming out saying he will be Chancellor by the end of the year. The CAC 40 is gaining 0.4%. You had some solid revenue prints in terms of forecasts, at least from the advertising company Publicis. Here in the UK, the FTSE 100 is getting 0.5%. We've been talking about Brexit. That is back in terms of the dispute between Brussels and the UK. You had the Bank of England warning about cryptocurrencies and house prices as well, according to the RICS survey, just edging off slightly. They've been on this very strong run, of course, in the UK, as they have been in the US as well. Let's have a look at the sectors then and see how things are breaking down. Basic resources are getting a boost today on the back of those higher prices, certainly in terms of oil. Brent and WTI both above $80. In fact, Brent closing in on $84 a barrel. Basic resources currently gaining 2%, top of the list in terms of sectors, 30 minutes into the trading session, followed by technology, which had a strong day yesterday as well, again, as a result of those slightly softer yields in terms of US Treasuries. At the bottom of the list, you're looking at healthcare and utilities, which is currently flat. Anna.
Okay, the European banking sector I can see playing sort of mid-table there on your screen, Tom. Let's get back to the US bank earnings season. Bank of America kicks off a busy day for bank earnings today. All eyes will be on the lender's loan growth after JP Morgan's mixed numbers yesterday, and it was loan growth that kind of disappointed. The bank's M&A unit posted its best quarter yet, but shares fell as consumer and commercial loan growth remained challenged. Joining us now, Bloomberg's Asia Finance Managing Editor Candice Zacharias is with us. Candice, good to speak to you once again. So what were the high points from JP Morgan's results yesterday? Certainly the investment banking side holding up pretty well.
Definitely. I think, JP Morgan, the first big Wall Street bank to report on the third quarter, closely watched set of numbers, and it was boom time for the lenders deal makers. As you mentioned, they posted their best quarter yet in a year. That's shaping up to be a record for M&A overall. We saw investment banking fees jump 52%, with advisory almost tripling, equity underwriting fees jumping 41%, and there was also a surge in equities trading. Now, needless to say that this bodes well for JP Morgan's global peers, and particularly Goldman Sachs and Morgan Stanley, who have relatively more revenue exposure here. On the other side, on the flip side, we could see Citi show some weaker trading results given its focus on fixed income.
What did we hear about the loan growth or lack of loan growth at JP Morgan and what it tells us more broadly about the banking space, demand from consumers, demand from corporates?
Right, that's an important focus for investors going forward. And we've seen Wall Street executives start to point to some early indications. Small businesses and consumers are beginning to take on debt again after stimulus checks earlier in the year really depressed demand. I think what we're seeing from JP Morgan's figures, though, is that that real turnaround is still some ways away. Overall loan growth came in 6% higher, but it was thanks to the asset and wealth management arm and corporate and investment bank. When it comes to consumer and commercial loan growth, those pieces still remain elusive. And we had the CFO come out and say that credit card balances should begin to grow. Again, he expects it'll take some time before they return to pre-COVID levels. So as you can see there, those are the numbers I think that some in the market were focusing on, and there's still, a lot of ground to be made up.
Yeah, the stock yesterday falling more than 2%. Thank you very much indeed, Bloomberg's Candice Zacharias. Okay, switching to Banco Santander now. The chairman, Ana Botín, says no one should be left behind as banks strive to transition to a climate-friendly future. She spoke exclusively to Bloomberg's Francine Lacroix.
Our big task as banks, most of us are net zero in our own operations, and the big thing is how do we help our customers transition to green? So what we need first a common language. Yeah. We call it taxonomy. So what is green? We need to ensure that stress tests are aligned across countries and regions. We also need governments to have policies that are common, because otherwise you're going to have unintended consequences and, others financing what some are not financing. And so we do need that clarity and coordination, hopefully across the world.
So will we get it? If you look at some of the anxiousness in banks right now, partly because of asset managers, partly because people say, well, look, if you have credits, it doesn't really help with the root of the problem. How much more will be done in the next 2 months?
Well, I think I think COVID has helped us because we've realized that we depend on each other. And it's exactly the same for climate change. And even though some people say you're not seeing it, extreme weather, you're seeing a lot of the signs that we are in a very dangerous path. And so I think that consciousness that it has to happen now and it has to happen working together is very much with us in the private sector, banks, governments, regulators. So there's a real push for coordination happening and for having clarity. What is green? How do you measure? What do we do about it?
The EU, for example, changed some of their metrics and saying some products are, not labeled or should not be labeled green, and they were in the past. Will we see a similar move from Asia and the US and others?
Well, that's a goal that we have, I think, with COP in Glasgow, is that we have more alignment on the global standards. And again, we need to speak the same language. Otherwise, it's not going to be done in the right way. My biggest concern is not leaving customers behind. We are seeing that with the energy price increase. Going green will have a cost, but there's also a huge opportunity for business and investment. And so doing it in a way that we can bring along the more vulnerable customers, the developing economies that are not starting in the same place as us. I mean, in Brazil or Mexico, people need a home, not just a green home, a home. And so how do we get this done in a fair way across different countries and sectors?
That was Banco Santander's Chairman Ana Botín speaking exclusively to Bloomberg's Francine Lacroix. She was giving her thoughts on climate change and the transition to greener technology. Let's think about how that is going as we sit here with oil prices at 83.89 on Brent, up another 0.9%. So we've seen these elevated oil prices, at least versus recent history. Interesting to see we're getting some lines coming through from the Saudis and the UAE energy ministers, not having any impact on prices, as you see on the screen just now. The Saudis talking about a challenging year for OPEC Plus in 2022, but a couple of lines that struck that seem to suggest they're not in any hurry to increase production. They're saying that the oil price increase is much smaller than gas and coal. OPEC Plus has done a remarkable job, the Saudis say, at regulating oil prices. The UAE energy minister saying he is not worried that we will have overheated oil markets. We'll just keep an eye on oil prices with all of those lines in mind. Let's get a Bloomberg First Word News update. For that, we go to Angel Feliciano. Good morning, Angel.
Good morning, Anna. Germany's Olaf Scholz says an SPD-led government will drive forward an expansion in renewables and energy infrastructure investment. On a two-day trip to Washington as Germany's finance minister, he expressed confidence that he'll form a government by Christmas. Speaking to Bloomberg TV, he also weighed in on Europe's energy crisis.
There are a lot of prices that increased for oil and gas, for instance, which is also due to the economic recovery we see worldwide and some other reasons. But so far, all the experts tell us that in the next year we will have a normalization of price inflation again.
Police in Norway are considering if an incident that saw 5 people killed and 2 injured in a bow and arrow attack was an act of terror. The assailant is suspected of acting alone when he walked around shooting in the center of Kongsberg, a town about 1 hour's drive away from Oslo. Police says officers around the country will be temporarily armed as a result of the incident. The Turkish lira has dropped to a record low against the dollar after President Recep Tayyip Erdogan fired 3 members of the central bank's rate-setting committee in a midnight decree. Bloomberg understands the changes rid of the committee of members who disagreed with Erdogan's calls to continue cutting interest rates despite high inflation. The World Health Organization has proposed a new team to lead an investigation into the origins of the COVID-19 pandemic. The 26 proposed members of the group were selected from 700 applications and have expertise in a range of areas from epidemiology to biosecurity. A controversial joint WHO-China mission earlier this year found that the coronavirus probably spread from bats to humans via another animal. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom.
Angel Feliciano here in London. Thank you very much indeed. Okay, coming up, we look at the age-old debate of value versus growth with a veteran of the investment industry. Our interview with Rob Arnott, chairman and founder of Research Affiliates, is next. This is Bloomberg.
What did you think at the low point of the Greek economic debacle? What were you thinking about to make Greece recover as it has?
Well, Tom, we took over in July 2019 with a very clear mandate to make the economy grow again. We were hit by the pandemic, but we still managed to implement very significant reforms, and I think we used the fiscal room that was available to us to support the real economy. We're very encouraged by the recent data. The economy grew 16.2% in the second quarter of this year. We revised our forecasts upward to 5.9%, and this may be a pessimistic forecast for 2021. We see lots of interest for foreign direct investment by American companies, European companies. We're making big progress in digitizing the state. We have a very ambitious green transition plan. And overall, I think the mood in the country after 10 years of crisis has significantly changed.
Watch Bloomberg Surveillance to learn how to look at markets, how to look at trends, and how to look younger.
What do you think, John? Botox, or do I really need to get something done?
I think, Tom, if we just change the style up a little bit.
You think so?
Yeah,
You
drop,
look
drop
great.
the bow tie. Drop the bow tie.
What,
Drop
skinny
the bow
tie?
Yeah. I always say, this is my line, whenever anyone in America has to go at me about a skinny tie. The older you get, the wider it gets.
Oh, really?
Until it becomes a bow tie.
This is a bow tie.
Until it becomes so fat, you just sort of...
I'm going to be cautious here because bubbles can last longer and can go further than anyone can possibly imagine. I would say that if you're thinking of buying tech, if you're thinking of buying some of these frothy growth names, first ask yourself, what's my exit strategy? If you don't have an exit strategy, don't go in because you'll ride it up and then all the way back down. And we don't know where that turn is. I liken it to picking up nickels in front of a steamroller.
At this point, does it seem to you that fundamentals matter at all?
To the market, no. Ben Graham famously said back in the 1940s, the stock market in the short run is a voting machine. In the long run, it's a weighing machine. And the weight of the future growth prospects is very light relative to the price. If Tesla saw its profits grow by 50% per year for the next 10 years, that would mean profits 10 years from now are 55 times as large as they are today. If that happened and you discount that back to today, you get a fair value of about 400. Do I think it's going to grow 50% a year? No. Amazon grew 27% a year, which was enough for an 11-fold growth in 10 years. The projection of 50% growth means 5 times as much growth over the next 10 years. I don't see Tesla growing faster in the coming decade than Amazon did in the last decade, and you'd have to assume 5 times that growth in order to justify even half today's price.
Which takes us to the top line on what you think about tech valuations. You say high evaluation shares are now endanger the investor. You say the analogy is similar to the South Sea bubble. How much of a repricing in growth or tech are you seriously expecting, Rob? And what is the trigger to that?
I love the catalyst question because whatever the catalyst is, it's got to come as a surprise to most of the market. Otherwise, it wouldn't be a catalyst.
Yeah.
But there are many possibilities. I love to frame things in the context of a very simple question. What's going on today that will matter in 5 years? COVID? Nope. Current supply shocks? Nope. Soaring debt and deficit? Oh my goodness, yes. Demography? Yes. These things all would point in the direction of value doing fine and tech reverting towards historic norms of fair value. So I love the question, what matters 5 years from now, because it can help us clear the noise out of the way.
Okay, that was Rob Arnott talking about the big tech bubble to Bloomberg's Danny Berger and Manus Cranny. Anna saying that you are facing severe risks, significant risks, if you're investing in technology at this point and you don't have an exit strategy.
Yeah, some really interesting, accessible commentary on how expensive he thinks technology shares are at the moment. It's really interesting to hear him talk about bubbles as well. If he thinks it's a bubble, he also recognises that bubbles can last much longer than you would be able to rationalise, and so that's important to be mindful of. And the catalyst question from Manus is really interesting, because if you see a change coming, you also have to understand or work out what is going to bring that change about. You might think that something's expensive, but what is going to make the rest of the market realise that as well? And it would have to be a surprise to a large majority of people, as he pointed out there, which is...
And that's key, isn't it? Because even if the fundamentals, even if the data suggests that these companies are overvalued, if the sentiment remains positive on them longer term, the likes of Cathie Wood and others, then, of course, these stocks can continue to rally. But in terms of the balance sheets, that is something often people talk to, is just like the strength of the company's balance sheets and the fact that technology, of course, will be underpinning future growth and future economy.
Let's talk to Danny Berger, shall we? She was conducting that interview along with Manus Cranny. Danny, good morning. Really interesting to get Arnott's thoughts there. If he thinks then that if he's bearish on tech, what is he buying? Because we've spent a lot of time talking about the things he doesn't like.
Yeah, well, he really likes value, and anyone who follows Rob Arnott, and there are a lot of people who do, know that he's liked value for a very long time. He's a very prolific writer on it, hundreds of research papers, but what's different this time is the opportunity he says that value presents. It is cheaper compared to the growthy stocks than it was during the dot-com bubble. He said that when the dot-com bubble was happening, the opportunity to buy those cheaper stocks, he thought he'd never see again in his lifetime, but he says we are here yet again. So now is a very unique time. The window won't last long, so if you're looking for something to buy that will have greater returns into the future, he says, go in, buy value, especially UK value.
Danny, we love a public debate, and we've had one between Cathie Wood and Rob Arnott. What is he taking issue with when it comes to Cathie Wood's strategy?
Yeah, Rob Arnott loves a debate as well. He never shies away from it. He basically said that the issue with what Cathie Wood is doing is that you can have a really fantastic company, but if it's expensive enough, it's a bad stock. And that's what he sees, for example, for the likes of Tesla. He says that fundamentals just aren't attached to reality when it comes to the stock price, and that disruptors get disrupted. You can't say just because it's a disruptor, it's worth these sky-high valuations. Now, he also takes issue with some of the other things that Cathie Wood and many people who are these momentum-type investors like. Bitcoin, he said that he, first off, doesn't invest in things he doesn't understand, but he says that Bitcoin just doesn't act as a source of money would. It's not a reliable store of value. You can't use it for transactions. It's very expensive. And because all of these things, he says there's a very good chance it's a bubble. There's a very good chance it will disappoint its long-term holders. However, he says he wouldn't bet the farm on that just because of, well, the volatility in the crypto space.
Okay, seems a very good chance that regulators are coming for crypto at some point as well. Danny, thanks very much. Bloomberg's Danny Berger bringing us the highlights of that really interesting interview.
Okay, coming up, European stocks move higher with US futures as investors take in their stride. Further signs of global inflationary pressures from the US and China, of course. We'll get all the market latest with our M-Live strategist, Veneram, next. This is Bloomberg.
during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to the European Market Open. 53 minutes into a positive trading session for European equity markets, moving it to the upside. Let's get into a markets conversation. Joining us now, Ven Ram, Bloomberg's Markets Live strategist. We see these stocks heading higher this morning, Ven, possibly pushing up valuations. And I like the way you start your piece this morning. The US stock market, so over in the United States, is now worth more than the combined economic output of 5 of the world's biggest economies, underscoring how lofty valuations have become. But Tina springs to mind. Ven, what excuse for it is there?
Morning, Anna. That's absolutely right. Tina is the big explanation for this. You know, you've got to, at 47.5 trillion of market capitalization of the universe of US stocks, that represents like 210% of the US GDP output. That means that, you know, we are not going to be able to close the valuation gap anytime soon, regardless of how the economy fares. I mean, if you take a look at the long-term trend growth of the US, which is about 3.2%, thereabouts, that will take more than 25, 30 years to close that output, the gap, where the market is already suggesting the output will be. So it's a long haul, and with rates lower for longer, albeit the Fed on the cusp of tapering, I do think that, you know, valuations will remain stretched for a long time, and that's unfortunately the world we live in at the moment.
Ben, tell us about the death or not of the 60-40 strategy. It's been called a number of times before in terms of the end of this strategy, but are we there yet? I mean, given the idiosyncrasies of today's markets?
Absolutely, Tom. You know, the people have called the death of the 60-40 strategy for years now. Back in 2019, I think Bank of America came out with a note saying that, look, I mean, this is the end of the strategy, people should move on. But if you look at the 60-40 strategy that Bloomberg has on its terminal, that has run up like 25% since that call was issued. So clearly the death of the 60-40 strategy is exaggerated, and it's not likely to happen anytime soon. Why do I say that? Because, you know, the Fed is, even though they're going to start tapering soon, we are still in a very much accommodatory mode, because they are still going to be buying bonds, albeit at a smaller pace. So that just means that, you know, we are not going to get a process of normalization anything close to where we were before the great financial crisis anytime soon.
Okay, so we won't talk about the death of that strategy just yet then, according to Ven Ram. Thank you very much, Bloomberg Markets Live strategist. Thank you very much for joining us. That is it for the European Market Open. Tom, I'm drawn to the oil price once again, still pushing higher, just over $84 once again on the Brent price, and with our ongoing focus on inflation.
Yeah, and as you astutely pointed out, the Saudi oil minister coming out and suggesting they really are really in no rush to ramp up supplies, at least at this point. Surveillance Early Edition is up next. Stay with us. This is Bloomberg.
How far will the Bloomberg surveillance team go to get the inside story?
The UK will deploy its reserve tanker fleet this afternoon.
There we go.
Tom McKean and I might be part of the reserve fleet
It might be.
that gets deployed.
This is more complex than people think. The steering wheel's on the wrong side of the truck. That's the first thing.
Oh my God.
Thank you to the gentleman out on Twitter that captured this moment.
Wait, question.
Wonderful.
Who of you has a driver's license?
You don't need that.
How did you make the decision to move to the Bahamas of all the options out there?
We've been looking at the Bahamas for a while. They're one of the first countries to roll out any comprehensive regulation for cryptocurrencies, which we think is extremely important for the space and a really positive sign.
I'm very concerned that the chairman of the Federal Reserve has not taken on board the real risks associated with climate change.
Going green will have a cost, but there's also a huge opportunity for business and investment.
We have a generation of central bankers who are defining themselves by their wokeness.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Fed minutes flag an imminent start to tapering, while pandemic stimulus in the U.S. could end by mid-2022. CPI prints above 5% again. China feels the price pressure as well. Factory inflation hits a 26-year high. The PBOC governor says inflation is moderate overall. And Anna Botin exclusive, the Santander executive chair, tells us that she sees inflation as temporary, spurred by COVID. More from that interview throughout the hour. Now, first thing is first, let's check in on the markets. Now, of course, the debate is always on inflation, of what we'll hear from the Fed. A bit of repricing when it comes to treasuries. We're seeing a nice lift to the stocks Europe 600. The S&P 500 futures also gaining some 0.6%. You can see we actually had a repricing from HSBC on the 10-year yield. That was from Stephen Major. 1.53 is where we're seeing it right now. And then the story with crude oil, we'll speak to the IEA shortly. The big stories, of course, is energy producers in the UK also going under. But the Turkish lira sliding, that's one of our biggest market stories, sliding to another record after President Erdogan fired 3 central bankers in a midnight decree. Now, the ousters really come, we understand, after the president met with the governor and the targets opposed Erdogan's push for lower rates. The shakeup really paves the way now for even more exertion from the Turkish president, and he is a self-described enemy of interest rates. And that's something that, of course, we've been talking about. He espouses unconventional theory that reduces interest rates will lead to lower inflation. That's the slide of the Turkish lira over the last 3 years. If you look at some of the materials, I mean, look at the UK quite significantly, because energy prices are seeing a lot more pressure in the UK than elsewhere in Europe. And then, of course, we had Vladimir Putin saying, well, he's happy to send a lot of the things, or a lot of the gas supplies over to Europe. A lot of these leaders, of course, have to ask at what price. But for the moment, we're seeing a little bit of a lift to a lot of these European indices. Now, the IEA has released its latest monthly report. They say the ongoing energy crisis has prompted a move to oil that could boost demand by 500,000 barrels a day. Now, the agency says there's been a massive switch to oil products and direct crude use for power generation. Well, we're now joined by the IEA's oil market division head, Toril Bozzoni. Toril, as always, thank you so much for giving us a little bit of your busy schedule. When do you see things normalizing a little bit? I mean, we had this energy supply shock. More people now wanting to use oil. Does it stabilize, or do we increase our demand for oil overall?
Good morning, and thank you for having me. Yes, as you said, the energy crisis that we're seeing, the increase in natural gas, coal, LNG, is prompting many consumers to switch to the use of oil for power generation. We're seeing increased use of oil in standalone generators where there's power shortages. So we have increased our demand for oil for the rest of this year and into 2022 by about 500,000 barrels a day, as you said, due to the switching to oil from other energy sources. As a whole, we raised our forecast for growth this year by about 200,000 barrels a day, the same for 2022. So now we're seeing growth of 5.5 million barrels a day this year, another 3 million barrels a day in 2022. Of course, the higher energy prices is also...
Yeah, I mean, I guess a follow-up to that is, given what, the numbers that you've just laid out, what does it mean for OPEC Plus? Do they need to reconvene and put more barrels of oil on the market?
As we say in our market, we're seeing really strong supply growth also in the coming months. From September to the end of the year, we're expecting oil supply on a global level to increase by 2.7 million barrels a day. That will go a long way to meet the increased demand for oil. But as our balances show, it's not enough to meet the demand for the remainder of this year. So we already seen oil inventories declining very rapidly all over 2021 and since the peak mid-2020. And we're expecting those stock draws to continue until the end of this year. The market will remain tight. Obviously, if it's a colder winter, we could see even stronger demand for oil the rest of this year. So the market will remain in deficit as we see it based on our forecast for demand through the end of the year. 2022 is looking a bit better. So if we don't see a very, very cold winter and even stronger demand, we're expecting things to improve in 2022. But at that time, even if supply could exceed demand at that time, it will be needed to replenish the inventories that are already way below the 5-year average that we're seeing. So we're seeing things improving, but the market will remain tight for some months more to come.
Toril, we heard, for example, Citigroup actually expecting 1 million barrels a day or more as a possibility because of the switching from gas to oil. You're, confident that actually it rebalances. Are you confident in your forecasts on this? Could you have to actually put them right? I mean, are the analysts wrong, or are you just very prudent in calculating the switch?
Well, we've taken a very close look at the capacities that are available in power generation across the world. We're seeing some switching already taking place in China, in India, in Asian countries, Japan, also in Europe. But based on the capacity that we think is available, switching from gas to oil in terms of standalone generators, we think that the 500,000 barrels a day of extra demand on top of what would normally been the case under normal circumstances, we're pretty confident. Of course, the higher energy prices, the blackouts, rolling blackouts in many countries has also led to slowdown in industrial activity. We saw that even before the latest run-up in prices. Production, a lot of industry, energy-intensive industry, have been forced to stop or reduce their activities due to the high energy cost or due to the lack of electricity. So this will have an offsetting impact on energy demand, we think. And as we've seen in the latest economic forecast for major institutions, they're already downgrading their growth for this year. And lastly, just to say, as oil prices are rising, we're now at 7-year highs. As you said, gasoline prices are also at record high in many countries. And this, we think, also will have a dampening impact on demand going forward as consumers faced by higher energy prices are reducing their demand.
Thank you so much. Toril Bozzoni there, head of the IEA Oil Market Division, joining us this morning. Now, the energy crunch has closed 2 more UK energy providers, Pure Planet and Colorado Energy, closing affecting 250,000 customers. Now, this news comes as UK gas supplier CNG Group announces it will stop providing gas to its utility clients, foreshadowing further closures. In total, 12 energy companies have closed so far since August, affecting 2 million households. Well, to discuss all of this is Bloomberg's Jess Shankelman. Jess, great to speak to you. So what do these closures actually mean for the industry?
Hi, Francine. Yeah, so we've got a bit of a chicken and egg situation here with CNG. Another 250,000 consumers are this morning discovering that their energy supplier has gone bust. CNG says it's going to stop supplying gas to the UK, but it has another 18 suppliers which now are going to be threatened by this move, which means even more small suppliers find themselves at risk of going bust this morning.
So is the market only suitable for large companies? And actually, how much more pain, Jess, will we see here in the UK?
Yeah, well, I think you have to look back. A couple of years ago, people were complaining that the UK energy supply market was dominated by the big 6 companies. So what the UK government did was they tried to introduce more competition into the market And at one point, we had 70 different suppliers as a result of that. That was great for consumers. Many people I know, they switched to smaller suppliers that were promising different things like cheaper energy or greener energy than the big six were offering. But what's happened is that those smaller suppliers weren't able, they didn't have the cash to hedge against volatility in the market, and as a result, they've been unable to stay afloat. So the way the UK market works, the rules are that the bigger suppliers then have to kind of swallow up the smaller customers that now find themselves without a supplier. So it does look like we're heading back to a situation where the bigger companies have the margins and the cash to be able to deal with this kind of volatility.
Jess, thank you so much. Jess Schenkelman there joining us with the very latest. Now, coming up, the death of the 60/40 portfolio. Up next, we speak to Christian Muller-Gleesman, Goldman Sachs Managing Director for Portfolio Strategy. We'll ask him why he thinks now's the time to pull the plug on one of Wall Street's favorite strategies. This is Bloomberg.
Dealing with that blackout risk, those energy prices spiking?
Well, in the first instance, we will manage it over the next while. I think the key agenda item for Ireland on the energy front is wind, and we've been great developers of onshore wind. The next decade in Ireland will be offshore wind, and we have streamlined our planning application framework for investors so they have certainty in terms of applying to invest in terms of offshore wind infrastructure in Ireland. So that will be a key agenda item of ours, and renewables. We have a very strong climate component in our government and in our government programme, and that, of course, is not disconnected from the energy agenda. And there will be challenges of that, there is no doubt, but we are making considerable progress.
Are you worried about the here and now? Are you worried about blackout risks? Are you worried about the amount of consumption data?
Data is taking up considerable demand in energy terms, but we have been robust in terms of meeting that to date.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
In-market scale and global scale. And so our global scale is 150 million customers. In 2019, I think with you here in London, we said we'll be investing 20 billion over the next 4 years in technology to make the transformation. We very much believe we need, and we have decided to work along three verticals or three strategic, let's say, priorities. One is what we call the One Santander. How do we make a single global platform that is at the same time able to compete locally? Again, 150 million customers across Europe and the Americas. The other one is our PagoNext, which is our global payments company. Yeah. And then we have the digital consumer bank. So we're going to both do it inside the bank and also within an autonomous payments company that we believe can be one of the top 10, 15 global payment companies in the medium term.
Santander Chair there, Anna Botín, speaking exclusively to Bloomberg. We'll hear more from our interview with Anna Botín throughout the program. Now, Wall Street is turning sour on one of its most popular investment strategies. A growing chorus says the recent synchronized sell-off in equities and bonds is just the beginning, and it spells disaster for the 60/40 portfolio. Goldman Sachs says the growing dominance of technology means bonds present a greater risk than when the strategy was popularized, and that losses from 60% stocks, 40% bond portfolios could swell to 10%. The death of this particular strategy has been called before by Bank of America back in 2019. So how did that bet fare? The 60-40 model returned 27% on the year. So is anything different this time around? Well, we're joined by Christian Muller-Gleesman. He's Goldman Sachs Managing Director for Portfolio Strategy at Asset Allocation. He was one of the authors of Goldman's report signaling the end of the 60-40 strategy. So thank you so much for joining us. As always, Christian, give us a sense of actually what replaces a 60-40 portfolio strategy.
Yeah, listen, I think the problem with that strategy is a bit like the problem with investing in general. Like, everything is expensive, and it has been expensive for a few years. So I'm not surprised at all that, you had other people worried about the 60-40 portfolio before. We actually wrote a report in 2017 called The Balance Bear. And I think little did we know that things could get more expensive and real rates could go even lower. But at the margin they did. But it doesn't change the fact that you're at a very poor starting point with regards to valuations. And at the margin, the big problem is that essentially both equities and bonds are expensive at the same time. No, and I think that's a big difference compared to the past, where bonds were usually buffering equities on the way down when they were kind of struggling, and vice versa. Actually, equities were a very good hedge for bonds when they were selling off. And that's getting much tougher now, because you mentioned it earlier, tech and like secular growth stocks are such a big proportion of the market now that they actually suffer if rates are going higher. So net equities cannot do as well as they used to in bond bear markets, because the index makeup is not really benefiting that much from higher rates. So you were asking what's replacing it? Listen, tough when everything is expensive, no? But happy to talk about some strategies we've devised. But in the end, it will require a much more in-depth approach, much less buy and hold, much more broadening of diversification, much more use of derivatives.
What does it mean, Christian, for some of the repricing that we've seen? I don't know whether it's Treasury or actually equities. What's your main concern right now? Is it still inflation and central bank policy mistakes?
Listen, you hit the nail on the head there. I think the big problem, besides the elevated valuations, is that we're going through a period of rising inflation expectations, rising inflation surprises, with somewhat good growth levels, but negative macro surprises, and at the margin concerns about growth, not just for the next few months, but the next cycle. And that means both equities and bonds are currently having headwinds. But as you said, the big problem in all of this is central banks, because you can deal with the higher inflation and you can deal with higher inflation expectations. We've had that for the last year. But the important thing to watch is the real yield. Is the TIPS yield actually starting to move higher? And you might have noticed the drawdown in 60-40 portfolios, which peaked at kind of 4% or so. That came alongside rising real yields. And that is the big problem, because that weighs both on equities and bonds at the same time. And they're very closely linked to what central banks are doing, because so far the higher inflation hasn't really led to longer dated real yields going up for a variety of reasons, but the key one being that the market doesn't believe it will trigger a really strong, prolonged Fed rate hike cycle.
So, Christian, what would you be buying right now?
Listen, at the margin, asset allocation is all relative. So you kind of need to think about, like, if everything is expensive, you need to kind of tilt your portfolio to the least expensive areas. And clearly, you need to also accept that your absolute return potential is more limited. And you need to think about more new approaches to achieve the best return. So what does that mean? At the margin, we think that more diversification within assets is important. So the last cycle, it was all about owning US equities, owning US tech, and just sitting on it. And we think the coming cycle will be much more about diversifying portfolios regionally, across styles, across sectors, focusing on alpha. I think that seems somewhat obvious, but it's going to be more difficult. It's going to be less easy. And in terms of the bond proportion, you need to think of new ways how to protect the portfolio. No, you cannot rely on bonds only. That might mean you have a bit more real assets to address the inflation risk. It might mean that you using derivatives or tactical or risk management strategies like vol targeting a bit more. But the key goal always has to be to steepen the efficient frontier. Now, that's how you kind of essentially position yourself in the best way for a low return period. You try to get a steeper efficient frontier. And as you know, it's not really about the 60-40 portfolio. You need to find the optimal risk reward, and then theoretically you should lever that. In the last cycle, the best portfolio was actually not 60-40. It was a risk parity strategy, which is more like 40-60. So from that perspective, the coming cycle, we feel that you want to own a bit more equity than in the last cycle based on that optimal portfolio. So maybe it is more like 60-40, but the 60% is not the S&P and the 40% is not bonds. You kind of need to find a few different opportunities, both in the risky bucket and in the safe bucket.
Christian, thank you so much. Christian Muller-Gleesman from Goldman Sachs. Now, later on in the program, we also hear more from my exclusive interview with Anna Botin. The Santander chair told me she sees the current inflation spike as temporary. This is Bloomberg.
The 1972 Madison Square Garden eyelet jumpsuit, which is arguably, from what we're finding out, probably one of the most important jumpsuits of Elvis's entire career. So it marked so many milestones, really, for him. It was used for an album cover. It was used when he performed Madison Square Garden, and he was the first performer to ever sell out 4 nights straight in Madison Square Garden. So he really started that whole thing that we see now in pop culture, where when you make it big, you do Madison Square Garden. So we're super honored to have it. I can honestly say that COVID has been unbelievable for internet-based and e-commerce businesses, because we have a captive audience. We have people home that really want something to do and need entertainment. So we do our best to try to give it to them.
Google is saying it has accelerated innovation in the country, and it's planning to appeal the FTC's decision. What's your take on this, and how do you plan for further scrutinies?
We are going to see what they make and like what changes they are actually bring to this market.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Economics, finance, politics. This is Bloomberg Surveillance, early edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Germany's Olaf Scholz says an SPD-led government will drive forward an expansion in renewables and energy infrastructure investment. On a 2-day trip to Washington as Germany's finance minister, he expressed confidence that he'll form a government by Christmas. Speaking to Bloomberg TV, he also weighed in on Europe's energy crisis.
There are a lot of prices that increased for oil and gas, for instance.
which is also due to the economic recovery we see worldwide and some other reasons. But so far, all the experts tell us that in the next year we will have a normalization of price inflation again.
Now, the EU and UK are braced for a new round of negotiations in London over the coming days over trade barriers in Northern Ireland. That is after Brussels unveiled a set of proposed adjustments to the trade protocol that would slash customs checks into the territory by half and cut sanitary inspections on many retail goods by 80%. The British say the existing agreements are just unworkable. And the Turkish lira has dropped to a record low against the dollar after President Recep Tayyip Erdogan fired 3 members of the central bank's rate-setting committee in a midnight decree. Bloomberg understands the changes rid the committee of members who disagreed with Erdogan's calls to continue cutting interest rates. Now, that's despite high inflation. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francie.
Leanne, thank you so much. Now, quite a lot going on in the markets. First of all, look out for some U.S. bank earnings. A little bit later, they start with Bank of America. Again, it will give us a good indication of what we heard from J.P. Morgan yesterday and whether it's the right way to look at some of the markets. The other big story, and we're all over it, is the Turkish lira at a record low once again. President Erdogan ousting a trio from the central bank rates panel. Again, we've been talking about it all morning. He has some unconventional way of looking at economics. A self-described enemy of interest rates, President Erdogan espouses this theory that reducing interest rates will lead to lower inflation. You can see a Turkish lira at 9.1292. Now, later on in the program, we also hear more from my exclusive interview with Anna Botin, the Santander executive chair, telling me she sees a current inflation spike as temporary. We'll also get more thoughts from Christian Muller-Gleesman of Goldman Sachs. I know we have a couple of viewer questions, smart viewer questions on his building portfolio strategy, so we'll put those questions to Christian. This is Bloomberg.
OECD nations need to end coal use by 2030, developing nations need to follow suit by 2040, and we need coalitions of solidarity between countries that still depend heavily on coal and countries that have the financial and technical resources to support transitions, because it is essential that no more coal power plants are built.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Crypto
you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Fed minutes flag imminent start to tapering, while pandemic stimulus in the U.S. could end by mid-2022. CPI prints above 5% again. China feels a price pressure as well. Factory inflation hits a 26-year high. The PBOC governor says inflation is moderate overall. And Anna Butin exclusive, the Santander executive chair, tells us that she sees inflation as temporary, spurred by COVID. More from that interview throughout the hour. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Banco Santander's chair, Anna Butin, says she believes inflation pressures are linked to the pandemic and are transitory. Speaking exclusively to Bloomberg, she urged caution.
Well, there's a lot of talk, and this is linked to the big issue in financial markets today, which is inflation, which is this a temporary issue? And I believe it is, in the sense that, COVID is a one-off, and it sort of created a spike, but US, China already ahead of where they were pre-COVID. Europe will be there in Q1. And so I do think energy is a factor, but hopefully it's part of the broader picture of how do we green the economy at a cost that we can afford and that is fair, and where the cost is borne by everybody in a fair way.
And you have a great snapshot of the world because you have an overview of the emerging markets, of the UK, of Europe, of the US, of Asia. What worries you about what we're living through at the moment economically?
So first, let me say the positive. Okay. We're in a much better place than a year ago. 6% global growth for this year, 4% for next year. That's IMF latest predictions. It's actually pretty good. And so I think that is one thing. The other is, of course, governments, especially in the developed world, were very much, in a timely way, making sure that businesses survive. And so I think those are very positive signals. The other one is, of course, there's been a huge amount of savings. I mean, Spain, for example, in 2020 increased savings by 110 billion. That's almost 10% of GDP. On the risk side, what happens with the excess government debt? What happens when businesses and people are taking off life support? Do they go back to being, in a regular situation and able to cope? Is inflation temporary? Those are the issues we need to tackle.
And we'll hear more from my exclusive interview with Santander's chair, Anna Butin, later on in the program when she gives us her thoughts on the crypto space. Now, Christian Muller-Gleesman from Goldman Sachs is still with us. And Christian, we talked a little bit about inflation. We talked a little bit about your 60-40 strategy. We also have a great viewer question. So I love viewer questions. Thank you so much for sending them in. This person wrote in, Christian, for you, with the bond market being elevated, how do you, Christian, see that affecting cross-asset portfolios with a transitory narrative?
Oh, this is a very good question indeed, and that's something we're wondering a lot about. I mean, once we get away from the stagflation fears, once we get away from the sticky inflation story, which is, it seems to be a lot of a fourth quarter story because you have so many cross currents supporting inflation, oil on the one hand, labor markets reopening and efficiencies, a few kind of lingering COVID reopening effects like used cars, etc. But I think our view from the economic side is that inflation will actually come down, and it will come down quite sharply towards the second half of next year. So bond yields in that situation should possibly come down as well, led by the break-evens, of course, because the break-even inflation for the next 10 years has moved up a lot, especially in places like Europe recently and the UK. So now the big question is, when that inflation comes down, what happens to real yields? Because I mentioned earlier that the most important driver of valuations across assets and a 60-40 portfolio will be the TIPS yield and real yields. And my fear is that as we normalize, we come out of COVID, and this crisis has really pushed real yields to all-time lows, that as we normalize, both inflation comes down and growth kind of starts to kind of normalize to a mid-cycle backdrop, the upward pressure on real yields will continue. And there's another really important factor, which is just the inflation volatility and the macro volatility this cycle has had since the beginning of the recovery, that also should push up back in real yields. So at the margin, I would say that even if the inflation comes down, it will not be a huge relief for valuations across assets or another boost. It will at the margin continue to be a bit of a drag.
Christian, what do you do with gold right now?
It's another really good question. I mean, it's the most directly linked asset to real yields. So you can hear from what I said earlier, there is a few risks there, no? I think it feels like gold has at the margin a lot to lose if real yields move higher. There's two good things here. The first thing is that it's lagged materially the decline in real yields in the summer. So it seems like gold investors have not gotten that excited with the decline in real yields, so they might not get that worried with the increase in real yields, at least initially. And the other thing is the dollar. I think you do have a decent linkage to the dollar, and with the view that in the long run, the dollar will start to kind of take a downward trend again. I think you could also see gold being an interesting asset. But for fourth quarter, being bearish the dollar is very dangerous, because the US is the only economy which doesn't seem to have an energy crisis. So at the margin, if the energy crisis intensifies, you could say that the US is a relative winner. And then you don't want to be short the dollar, because Europe, as we know, is negatively exposed to these energy prices.
Christian, overall, what are you expecting from the earnings season? I know there's, energy prices, concern about margins being hit. I hear more and more strategists say maybe the banks is a good way to play this. I mean, we'll see what the U.S. banks come out with today, but maybe the banks are a good way to play this because of this incoming inflation. Like, what are you expecting in terms of earnings crop?
Yeah, it's difficult from here, no? Because I think the last few earnings seasons have been blockbuster. You had big surprises to the upside, driven by cyclicals, by value. And I think the expectations have moved up. And actually, economic forecasts from our team are by now in line with consensus, actually even below consensus for the fourth quarter. So it feels like to surprise to the upside is more difficult. But there's another thing, of course. Levels of growth are very good, but we've had these negative macro surprises. And that means at the margin, we currently are leaning more towards value parts of the market than cyclicals. And banks, they are clearly in the value bucket. I think we do still see the potential for those areas. Both energy and banks are the most prominent value sectors to surprise a bit to the upside, because they have so many macro tailwinds that are specific to them. Steeper curves in Europe, of course, we discussed. I think at the margin that should support those banks. And generally, we just feel that there's still a decent amount of longer-term structural pessimism with regards to banks, which allows probably to surprise to the upside for a bit longer, if you know what I mean, both with regards to prices and with regards to earnings estimates.
Christian, what's your take on the UK? So, I mean, there's the energy prices, compounded by also supply chain issues. Do you look at the UK and say, actually, it's apart from some of the other equity markets that we're seeing, or is it part of the same story?
Yeah, the UK is looking a bit scarier maybe on the economic side than other places in the world. I think the UK equity market, as you know, the FTSE 100 is not really closely linked to the UK economy. A large part of the revenue there is outside of the UK. These are international companies, and they actually have a lot of commodity exposure. So you can definitely see the UK equity market in a quite positive light into year end. It's also quite low volatility compared to other markets. So we kind of like that, but we've definitely seen the UK domestic index, like FTSE 250, and we have like baskets linked to the UK economy. They've suffered, and it's a lot related to the fact that obviously inflation levels, both realized and in particular implied, are much higher in the UK, and there's more pressure on the BOE to normalize policy. And that kind of means at the margin, the UK domestic exposures, they are a bit more risky into the fourth quarter, because as we said, the central bank tightening is really something that can scare investors.
Christian, thank you so much. Christian Muller-Gleesman there, Goldman Sachs Managing Director for Portfolio Strategy and Asset Allocation, joining us this morning. Now, coming up, a new era for Technicolor. We'll be joined by the Chief Executive to discuss the motion picture company's turnaround from bankruptcy. More on that shortly. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The next big thing, which is already here actually, is crypto. So I think that is it's already happening. You know, we talk a lot about the CBDC, central bank digital currencies. The fact is you already have around 100 billion of stablecoin dollars, US dollar, fiat currency, digital currency in the US today, unregulated outside the system. And so how do we think about that? There's a huge amount of innovation happening, and in an area that is very much systemic. It's about monetary policy and, you know, how that gets managed, whether it's inside or outside the system.
So how do you look at crypto? And actually, do you have to be, as a chief executive chairman, you know, a believer of crypto to be able to write, you know, have the right products for your customers?
Well, we are sort of a leader in crypto. We issued the first end-to-end bond on the blockchain, which is the technology behind crypto. We have a very strong group, not huge, but strong group on that. And the big thing is, how will central banks want to manage this? Will they manage it themselves? Will they create a framework and tell us how to do it? Will they do nothing? I think they will be working with us, with the banks. And it's also what role we want to play in that value chain, right? Yeah.
And I mean, how many customers actually want to buy Bitcoin? Do they come to you, or, you know, to your cashier?
They actually do, but we've been quite slow in adopting that because of compliance and, you know, regulatory and risk appetite. But we're now getting into it, so we're now either about to offer or already offering crypto ETFs. So being very careful about the know your customer, but being able to offer the product.
Banco Santander, their chair, Ana Botín's thoughts on the crypto space, speaking exclusively to Bloomberg. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Garrett. Hi, Leanne.
Hi, Francine. TSMC says it will build a fabrication facility for specialty chips in Japan and plans to begin production there in late 2024. That comes as the world's #1 foundry reported quarterly profit beating expectations as demand for chips stayed robust in the face of worsening supply chain problems. The The Taiwanese company has set aside $100 billion to grow output over the next 3 years. Now, finance ministers from the world's biggest economies have endorsed a global tax overhaul. 136 governments had earlier reached a deal over a minimum rate to be set at 15% for corporations. Plans for digital taxes have also been scrapped after the US said they were discriminatory. The stage is now set for G20 leaders to approve the accord at a summit later this month. Sources tell us that Amazon.com is shopping for used long-range Boeing 777s and Airbus A330 cargo planes, more evidence of the company's ambitions to move products from countries like China by itself. The plane models are bigger than Amazon's current fleet of Boeing 767s and would see the e-commerce giant set up a rivalry with UPS and FedEx. And Cathie Wood is joining the slate of Wall Street players hoping US regulators will soon greenlight an ETF tracking Bitcoin futures. The new ETF plans to invest in contracts that trade on commodity exchanges. According to Bloomberg Intelligence, 9 Bitcoin futures ETF applications were being considered by regulators at the beginning of this month. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Now, it's been a year since Technicolor shed roughly $770 million in debt as part of a $1.4 billion restructuring plan. Now, the France-based motion picture company has been boldly pursuing its turnaround plan under new leadership from Richard Mote. He has pulled the company out of bankruptcy, investing heavily in AI and AR technologies, and expanding partnerships with Netflix, Amazon, and Disney+. Well, we're delighted to be joined by Richard Mote, the chief executive of Technicolor. Welcome to Bloomberg Surveillance. And thank you so much for coming in the studio. Richard,
thank you for having me on.
I have a million questions. First of all, so you took this company, you turned it around, and now you're trying to areas of growth. There's something called the metaverse. And actually, maybe a lot of boomers watching us don't quite know what the metaverse is compared to the younger millennials. Is this where you see the main area of growth for Technicolor going forward?
Well, the film industry is coming roaring back during 2021 after a very quiet 2020 because of the pandemic. And we're taking advantage of that in all of the aspects of work which we do for the Hollywood studios and for the big streaming and episodic players like Netflix, Amazon, and Apple. But you're right that the metaverse is a coming element of the work that we do. And we think we're going to be a central element of bringing that to life because we can create characters, we can create avatars, virtual environments, all of the things which will be necessary to bring the metaverse to life. And just to give you one example of what we've done recently, we worked with a firm called Riot Games to produce a virtual concert of a virtual band called Pentakill, which has 7 members, none of whom are real. And they did their second concert recently in a sort of vast virtual arena space. And we did everything end to end for that.
So, Richard, overall, what was the problem with Technicolor in the past? I guess the million-dollar question is, why would people use Technicolor to use some of these characters instead of doing it in-house?
Well, I think that we combine getting the best possible artists using the best possible technology. We spend an enormous amount every year on research and development into new software, cutting-edge software, and that produces the best visual effects of all types for the Hollywood studios and for the streamers and, as you say, for the creation of the metaverse and indeed for big brands and advertisers around the world because we're the #1 supplier of visual effects to the advertising industry as well. So people know that we do things on budget, on time, and very high quality, and that's what they like to get from us.
So, Richard, what was your biggest challenge when you take over the company and you have to, really turn it around? I remember at the time we were talking about Technicolor, people were worried, saying maybe this is a Kodak moment for the company. So, is it reputational? Is it trying to get new customers? Like, how did you manage that?
Well, I took over almost exactly 2 years ago, and that was just before the pandemic struck, and nobody knew about it then, obviously. So we had to re-engineer the balance sheet, and as you say, we reduced our debt significantly. We got $420 million of new cash into the business, and that put us in a really strong position looking forward to the future from a financial point of view. But then we also had to do a transformation of the business to take a significant amount of the OPEX out, more than $300 million by the end of this year. And in addition to that, we wanted to refocus on the key areas of growth, which obviously is visual effects, the flagship area of the business. But we also saw fantastic growth from our connected home division, which makes broadband gateways and set-top boxes, because people locked down wanted to get better broadband and Wi-Fi experience, and we were supplying high-end products. And also, strangely, in the DVD division, where we're the largest producer of DVDs in the world, we actually saw huge demand for back catalogue titles, which we hadn't seen previously.
But your biggest challenge was what, one of reputation?
I think we always had an excellent reputation in the VFX division. So we had to restore our reputation, I think, with investors and with the general investing community. That was the biggest challenge. But the re-engineering was done in 2020, and we're looking forward to the future with some real confidence now.
So I hope to speak to you before 5 years, but if I speak to you in 5 years, how much of your revenue will actually come from films, TV series, and how much of it will come this new world of gaming and metaverse?
Well, we're getting about 50% of our revenues from the connected home division, and about 25% from film and 25% from DVD. But that's the film side of it is growing really substantially. And a lot of that is coming from the growth from the episodic and streaming players, because they want to get and keep more and more subscribers. And in order to do that, they need to improve the excitement which they provide in terms of the content, to provide a hook. And so therefore they're spending more and more money on visual effects, and that's playing into huge growth for us.
But I thought, Richard, that everything was done in-house. I mean, you're almost a middleman, right? Trying to provide services from some of these content producers, and they're snubbing a lot of the Hollywood studios. They're trying to do it in-house, like Netflix and Amazon. Do you think eventually you'll be bought out?
I think that we've got a crucial role to play. I mean, we don't produce original content. We do work for the Hollywood studios, we do work for the streamers, we do work for big brands like Nike and Apple. So we don't create that original content, but we do, as I say, do extremely high quality work, which we believe is better quality than anybody else in the business can do it. And as a result of that, we've got more than 20% worldwide market share. That, I think, is going to secure our position and secure our growth out into the future. So in 5 years' time, if you were talking to me then, I think that film would have become the predominant area of our business, and we hope to see continued growth beyond that.
Excellent. Richard, thank you so much for coming on today. Richard Mote there, the Chief Executive of Technicolor, joining us this morning. Now, this is what the markets are doing. A lot of focus, of course, on Turkish lira. I know it was one of our main stories. This is after we saw 3 firings, actually, from the central bank, from President Erdogan. So we're seeing Turkish lira at a record low. Overall, we're waiting for earnings. A lot of U.S. banks actually will report later on, and we're seeing a bit of a lift to some of these markets. This is Bloomberg.
China's growth because it is already slowing. Chinese manufacturers are curbing production. This is the latest shock to global supply chains, already delayed by, part delays, chip shortages, saddled with soaring commodity prices as well.
Well, Haslinda, when we've seen a lot of supply chain disruptions at the beginning of this COVID pandemic, and then, supply chains became resilient and it really moved goods around, especially medical goods and supplies. But now, at this part of the pandemic, we are seeing disruptions again. and discontinuities. And that is because of what we spoke about, the demand that is pent up. And of course, if you have factories slowing down and, not being able to produce as much, that is going to impact growth and the recovery.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims front.
How are you thinking about those dynamics?
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's take a look at some of the things to watch out for today. At 10:30 a.m. UK time, the EIA crude oil inventory report is due to be released. Then 1:30 p.m. UK time, we also have some U.S. data, including initial jobless claims and PPI, followed a little bit later by a number of big U.S. bank third quarter earnings, including Bank of America, Wells Fargo, Morgan Stanley, and Citigroup. Of course, we'll be monitoring all of those third quarter earnings from bank chiefs throughout the day, beginning with Morgan Stanley Chief Executive James Gorman, who's due to speak at around 3:30 p.m. UK time. Then the TD Bank Chief Executive Gregory Braca at 7 p.m. and Bank of America Chief Executive Brian Moynihan at 8 p.m. Wells Fargo Chief Financial Officer speaks to us at 9 p.m. as well. Now, it's also a busy day for a number of Fed policymakers. I told you this Thursday, just stay at home and watch Bloomberg, because we have a lot of news, many taking part in discussion across the country. The Atlanta Fed President Raphael Bostic kicks it all off as he takes part in a virtual panel, Inclusive Growth, hosted by the Aspen Institute at 10 a.m. UK time, followed by New York Fed Executive Vice President Loris Logan at 12 p.m. Then the Richmond Fed President Thomas Barkin talks at 1 p.m. At the same time, San Francisco Fed President, finally Philadelphia Fed President Patrick Harker at 6 p.m. Now, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller joins me out of Berlin. K-Lines will be in New York. We have you covered when it comes to U.S. bank earnings. We'll be speaking to our Sonali Bazek. We also have the very latest on the Turkish lira at a new record low after we had news overnight by a midnight decree by President Erdogan. This is Bloomberg.
Wrong with her eye. When I had a look, it looked like she was blind. The vet that she's registered with were only doing telephone appointments, which was a bit pointless because she really needed to be seen by someone, and I couldn't get one anyway for like another week. I was just quite worried about, the complications of leaving it for so long.
We've seen millions more animals
becoming pets in the past year due to the people having increased time at home. What we're also finding is due to Brexit that we're having decreased numbers of European vets working over here. So unfortunately, we're unable to meet that current demand for pet services. Also, COVID's got the inevitable impact with people having to self-isolate.
It is very limited what we can diagnose, so it's more about peace of mind and determining whether they do need to be seen in person.
Mercedes-Benz is on a path towards CO2 neutral mobility, so we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Watch Bloomberg Surveillance to learn how to look at markets, how to look at trends, and how to look younger.
What do you think, John? Botox, or do I really need to get something done?
I think, Tom, if we just change the style up a little bit.
You think so?
Yeah,
You
drop
look great.
the bow tie. Drop the bow tie.
What,
Drop
skinny
the bow
tie?
Yeah. I always say, this is my line, whenever anyone in America has a go at me about a skinny tie. The older you get, the wider it gets.
Oh, really?
Until it becomes a bow tie.
This is a bow tie.
Until it becomes so fat, you just sort of...
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
I'm very concerned that the chairman of the Federal Reserve has not taken on board the real risks associated with climate change.
Going green will have a cost, but there's also a huge opportunity for business and investment.
We have a generation of central bankers who are defining themselves by their wokeness.
This is Bloomberg Surveillance, early edition, with Francine Lacqua, Matt Miller, and Keely Lines.
Well, it's 10 a.m. here in London, 11 a.m. Berlin, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Thursday, October 14th. Our top stories today. The market's magic words. Investors are constantly hearing inflation and supply chain as executives at large companies discuss their prospects. More earnings are on tap today. Erdogan's midnight makeover, while the Turkish president fires policymakers at the central bank who were opposed to cutting interest rates. The lira slides, and power failure. 2 more energy suppliers in the UK go out of business, victims of unprecedented volatility in the natural gas market. So we have a lot of news today. We also have a lot of Fed speakers later on throughout the day. Kaylee, if you look at the markets, sure, we worry about inflation, but the traders actually focus on earnings.
Yeah, absolutely. And we get a lot more of them today, Francine. 4 more big banks will be reporting before the opening bell here in the U.S. So we're really just waiting and watching for that. Now, as for what the picture looked like in the Asian session, there was a lot of green. If you look at GMM Go on the Bloomberg terminal, you see green across stocks, currencies, bonds, really a broad day of gains in Asia. When it comes to the equity market specifically, Hong Kong was closed for trading today, but stocks were up about 1.5% in Japan and South Korea, though they did fall in China. And of course, that is after the inflation data we got out of China overnight. Factory gate inflation hitting its highest in 26 years. Producer prices up 10.7% year on year. And you can blame a lot of that on what we've seen in the commodity complex. Coal futures, for example, hitting another record high today. And now it's spread even to zinc, with futures hitting up 8% at one point because the power shortage is leading a lot of people to think that supply and production may be lower. In other asset classes, I would point to bonds in Australia. You had a September jobs report that showed a bigger drop in employment than expected. So we saw the 10-year yield coming in 6 basis points in that country. And then I would just point out in foreign exchange, the Japanese yen is your biggest underperformer in Asia and in G10. It is weaker against the dollar by about 0.2%. Now, here in the U.S., we are digesting yesterday's inflation data, those Fed minutes we got at 2 p.m. Eastern time on Wednesday, and then, of course, waiting for earnings. But as we await those, stocks are in positive territory, or at least futures are. S&P E-minis up about 0.6%, 0.7%. In the bond market, we are coming in just a touch after declining 7.5 basis points over the last 2 days. The 10-year Treasury yield now sitting at 1.53%. It is a weaker dollar story for the second day, and that in part may be what's lifting crude, but of course the power crunch globally is aiding crude as well. WTI up 1 percentage point this morning. We are north of $81 a barrel, Matt.
Yeah, Kaylee, the power crunch front and center here. And I'm glad you included zinc as well in your rundown. I noticed that on my GMM this morning. It's in a black box, which means it's moving 3 standard deviations or more away from its 30-day average. So that's one of the reasons that we have the miners doing so well here in Europe. You see a lot of green on your screen here. Miners and tech companies really leading the way in terms of the equities rally. Right now we're up almost 1% across major European indexes. And then we see big gains in commodities. As I said, that energy crunch is front and center. We see big gains in Brent crude, the global benchmark. We see big gains, even bigger gains in nat gas because of the UK nat gas story, which seems never ending, although it's only been, I guess, a couple of months now. And then look at that second row there. You can see the US dollar, Turkish lira, an all-time low. You can now buy more than 9.1 lira. Are we headed to double digits? It's a really interesting story that I think traders are watching very closely, because this is a currency pair that gets traded a lot. It's a big deal in the FX world. And it's also interesting that Erdogan seems to think cutting rates will help tame inflation, which is pretty much the opposite of what you learned, Francine, in Econ 101.
I know, it's been quite, interesting actually reading some of his comments. He's a self-described enemy of interest rates, and he does espouse this unconventional theory, as Matt Miller was saying, that actually reducing interest rates will lead to lower inflation. Now look at what's ahead today. It's another day of U.S. bank earnings with Bank of America, Morgan Stanley, Wells Fargo, and Citigroup reporting. At 11 a.m. New York time, watch the EIA crude oil inventory report, which comes out amid the energy crunch and a warning that U.S. consumers are set for an expensive winter. The U.S. FDA meets to discuss Moderna and Pfizer booster COVID shots, plus a slew of Fed speakers. Bullard, Bostic, Barkin, and others are set to take part in discussions across the day. Now let's get straight to that Turkish lira story. The Turkish president firing 3 monetary policymakers wary of cutting interest rates. This comes against the backdrop of a weakening lira already, which fell to a record low once again against the dollar. So let's get more with Bloomberg's Onur Ant. Onur, I mean, this could surprise many, but we know that President Erdogan does not believe in interest rates. So will he just have much more influence now on central bank policy?
Yeah, he surely does he surely has more influence now than he did about 13 hours ago after he fired 3 members of the rate-setting committee of the central bank. We have reason to believe, our sources tell us, that some of those people were opposed to Erdogan's desire for continuation of interest rate cuts after last month's unexpected cut to the benchmark rate, even as inflation was accelerating, Francine.
By the way, Onur, President Erdogan, he has been pressuring the central bank for some time to cut rates. Could this signal that there are now more cuts to come?
We do think that last night's firing do pave the way for possibly more rate cuts by the Turkish central bank. And already some of the analysts are have been revising their expectations for the interest rate path going forward. One of the Istanbul-based economists at HSBC Portfolio Management, for instance, just changed his call for a 50 basis points rate cut from a 50 basis point rate cut to 100 basis point rate cut for next Thursday's decision by the Turkish central bank.
Onur, thank you so much. Onur on there from Istanbul. Now, the energy crunch has closed 2 more UK energy providers, Pure Planet and Colorado Energy, closing, affecting 250,000 customers. In total, 12 energy companies have closed so far since August, affecting 2 million households. Well, let's get the latest with Bloomberg's Danny Berger. Danny, it doesn't look like it's going to get better as well.
Yeah, this is the problem. The energy crisis isn't easing, Francine. Now that we have 2 more providers closing, I should say Pure Planet, this is a BP-backed one. So these are significant. These aren't small, no-name type energy providers. And as you said, it's now 2 million people who have had to switch providers. That's the total of all the 12 that we've seen collapse. Now, the issue is that this could indeed add to already very high UK inflation, which has implications for the BOE as well. Now, there is a limit to how much much customers will have to pay if they switch to different providers because of government caps, because of fixed contracts. But this is also part of the problem. These large providers who all of a sudden have more customers coming on, they are already stretched. And for the small providers, they are having to go into the spot market, buy these sky-high prices because they are not fully hedged. So if you're not fully hedged, you have to go into the market, you have to pay more, and you can't pass that on to the customer because of some of these contracts and caps. This does mean that we could see more companies go the way of these 12 collapsing. It's certainly a warning we've heard from the UK Business Secretary.
Well, call it President Putin to the rescue, Danny, because he says Russia is ready to deliver all the natural gas that Europe and the UK need. What's in it for him?
Well, Kaylee, it's a great question. People familiar have told Bloomberg that Putin is hoping to press the EU to rewrite some of its gas market rules. And so he was speaking yesterday, the comments you mentioned, at a summit about Russia energy, and he used the opportunity to criticize the EU. So you get hints of what he's aiming to do. He said the European gas market does not look well and balanced enough to be stable. So really what he wants to do is to press the EU to go in and buy long-term contracts with Gazprom rather than short-term spot prices. This is better for Gazprom. Long contracts means more stability, less downside risk, and he wants to push through a faster approval of the very controversial Nord Stream 2. So him stepping in, acting as a savior type, it could be a big opportunity to get these reforms that he wants to see done in the EU.
Danny, thank you so much. No free lunch, I think, is what we learned from a young age. Now, over to Washington. President Biden says he wants to break a logjam at U.S. ports and stave off holiday season shortages and delays. Now, he announced yesterday that the Port of Los Angeles will begin operating around the clock.
This is the first key step toward moving our entire freight, transportation, and logistical supply chain nationwide to a 24/7 system.
Let's get straight to Jack Fitzpatrick, Bloomberg government reporter, joining us from Washington. Jack, what can the U.S. actually do to, get rid of this logjam?
It's a matter of the federal government trying to work with companies, but these are private companies' decisions that they're making. The announcement yesterday, late the day before, that the president made about 24/7 operations at the Port of Los Angeles and other similar expansions of schedules by major companies like Walmart and Samsung and Target and UPS were more about the president. I don't know if it's necessarily bullying, but it's sort of the use of the bully pulpit and trying to be a broker who works with private companies to get them to move things along. Really, at this point, there's not an influx of federal resources or anything along those lines, but this is a matter of the president trying to negotiate some private sector solutions just for an expansion of schedules and get things moving, particularly at night when they previously weren't.
Yeah, and Jack, how much harder do these supply chain issues make the job of the administration trying to push back on the idea that its policies have caused higher inflation?
Very difficult. Politically, the conversation about inflation, if you are on Capitol Hill talking to lawmakers, does not tend to get into the nuance of how much of it comes from supply side issues versus demand side issues. The 2022 midterm view of this is that Republicans are probably going to hit Democrats on inflation and tie that to their legislative agenda, including the stimulus payments, which are not irrelevant to it, but it really doesn't get into these more technical issues of supply chain issues. In fact, that's why you heard in his speech the president kind of try to lay out in plain English and say, you may have heard of something called the supply chain. That's a difficult message to send, though, so it's a politically difficult one for the president.
It's all about perception. Jack Fitzpatrick of Bloomberg Government in Washington, thank you so much. And now let's get back to the markets and take a look at some stocks moving in pre-market trading here in the U.S. And of course, we were just talking with Danny Berger about the energy crunch that's happening not just in the UK, but globally. That is actually giving a lift to some names, including Kinder Morgan, which actually could be higher for a 6th day in a row today. It, of course, is a pipeline operator, and it is up about 3% before the bell. Same goes for Devon Energy. energy and really energy stocks across the board, E&Ps in particular when it comes to oil companies. Devon is up 2% in pre-market trading, and this is a stock up 146% year to date. It is the best performer, actually, in the S&P 500 Energy Index in 2021 thus far. One number to the downside, though, is Wayfair, of course, the online home furnishing retailer. It got downgraded at Morgan Stanley. The analyst putting a $195 price target on the stock. That's downside of about 17% from yesterday's close. This morning, it's down the better part of 3%, trading right around $228 a share, Francine.
Kaylee, a lot going on in the markets. Coming up, it's a busy morning also for banks. Bank of America, Morgan Stanley, Wells Fargo, Citi, all reporting. So stay with Bloomberg for full coverage of those results with interviews with the chief executives of Morgan Stanley, Bank of America, the Wells Fargo chief financial officer as well. This is Bloomberg. We also have, of course, an exclusive with Anna Botín coming up, the Santander chair. She weighs in on the inflation debate, plus the investor all-stars. Some of the biggest names in private equity and Europe's most promising tech startups are meeting in London today. We'll be speaking to the chief executive of the fintech startup Molly and tech investor Carolina Borchado of EQT this hour. This is Bloomberg. Is inflation really transitory, or is there a risk that because we believe it's not transitory, it actually becomes sticky?
I think central banks are really worried about inflation now. Much of what we see probably is transitory, but nevertheless, it's a lot easier to see upside risks to inflation than downside risks. None of us know where inflation will go over the next year or so, but upside risks are coming, I think, from three sources. One, as we gradually learn to live with COVID-19, the bottleneck effects are pushing up some prices. Secondly, energy prices, we've seen, even yesterday, they moved all over the place for gas prices. We don't know where they'll go, but it's much easier to see upside risks than downside risks. And third, and I think one which is very different from the past 20, 30 years, is that the political risks are also much stronger. There's real pressure now to boost public spending, but not to raise taxes to finance it.
How far will the Bloomberg surveillance team go to get the inside story?
The UK will deploy its reserve tanker fleet this afternoon.
There we go.
Tom McKean and I might be part of the reserve fleet
We might be.
that gets deployed.
This is more complex than people think. The steering wheel's on the wrong side of the truck. That's the first thing.
Oh my God.
Thank you to the gentleman out on Twitter that captured this moment.
Wait, question.
Wonderful.
Who of you has a driver's license?
You don't need that.
Well, you know, there's a lot of talk, and this is linked to the big issue in financial markets today, which is inflation, which is this a temporary issue? And I believe it is, in the sense that, you know, COVID is a one-off, and it sort of created a spike.
You can have good growth with some inflation, and that, you know, that's okay. I think that people are always focusing too much on, you know, immediate concerns. You know, if you have inflation at 4% or 5%, we're still going to open deposit accounts and checking accounts and grow our business.
That was Santander Chairman Anna Botín and JP Morgan CEO Jamie Dimon speaking with Bloomberg earlier this week. And it's another busy day for U.S. bank earnings with Bank of America, Morgan Stanley, Wells Fargo, and Citigroup all reporting this morning. Sonali Basak, our Bloomberg Wall Street reporter, is going to be very, very busy. So Sonali, JP Morgan was first out of the gate. Results pretty solid. What kind of bar did they set for these four this morning?
A very high one, because we know that even with blowing through the roof in investment banking figures, the loan growth is still elusive. And so for Bank of America, the bar is quite high, Kaylee, because Analysts expect them to actually increase revenue from the prior quarter rather than decrease as we see at the other banks. That will all depend on the loan growth, right? Investment banking, we know, is doing well. They have to meet expectations, but they also have to show that net interest income is growing. For Citigroup, the largest card issuer, that's also going to be a big question mark, the card business in particular. And that was a particular weak spot for JP Morgan, where you saw the rest of the card issuers in the stock market also start to sell off yesterday.
So, Sonali, good morning from London. Wells Fargo, I guess we're expecting and hoping to have more, update on some of the regulatory issues. And then if you look at Morgan Stanley, it's really all about the investment bank.
Yeah, that's absolutely true. For Wells Fargo and for Citigroup, we want updates on regulatory issues. For Wells Fargo, they've been trading a little better in the stock market. We know Citigroup is still below their price to book value. So the bar is high for them to start showing improvements on Jane Fraser's strategy, though we know it's still early. For Morgan Stanley, where is the bar high? It's for equities trading. Citigroup, Goldman, Morgan Stanley among the top equity underwriters in the world right now, so that should flow through to equity underwriting. But as you know from yesterday, JP Morgan also set the bar quite high there, not only beating, but posting more in revenue than analysts expected over at Morgan Stanley, the biggest equity shop, and Goldman Sachs. So the market share will be a question.
My first thought yesterday, talking with Paul Sweeney on our Bloomberg radio show, how much are these bankers going to get paid? If they do so well in businesses like M&A and businesses like FICC trading and equity trading, they're going to expect big bonuses.
Yeah, they certainly are. We heard JP Morgan yesterday already say that expect expenses to go up because they do pay for performance. So if you're having a good year, you should be getting paid for it. Remember, we're also in the middle of what Bank of America CEO Ryan Moynihan has called a talent war. So there is this recognition that it's not just pay for performance, but pay to keep your staff, and we are seeing it at every level. At the end of the day, the expense guidance will be interesting. These firms are also spending on acquisitions, Matt, as well as technology. So there's a lot of pressure on margins at the end of the day into next year.
Sonali, thanks so much. Sonali Basak there with the very latest on these Wall Street titans reporting today. Stay tuned for interviews throughout the day with the Morgan Stanley Chief Executive, the Bank of America Chief Executive, and the Chief Financial Officer of Wells Fargo.
At the low point of the Greek economic debacle, what were you thinking about to make Greece recover as it has?
Well, Tom, we took over in July 2019 with a very clear mandate to make the economy grow again. We were hit by the pandemic, but we still managed to implement very significant reforms. And I think we used the fiscal room that was available to us to support the real economy. We're very encouraged by the recent data. The economy grew 16.2% in the second quarter of this year. We revised our forecasts upward to 5.9%, and this may be a pessimistic forecast for 2021. We see lots of interest for foreign direct investment by American companies, European companies. We're making big progress in digitizing the state. We have a very ambitious green transition plan. And overall, I think the mood in the country after 10 years of crisis has significantly changed.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons in New York with Francine Lacqua in London and Matt Miller in Berlin. Now let's get the first word news. And last month, Federal Reserve officials agreed they could start reducing emergency support for the economy in mid-November or mid-December. Minutes of the policymakers' meeting showed that there was increasing concern over inflation. Most participants saw inflation risk weighed to the upside. They also discussed whether labor supply would bounce back to 2019 levels. President Biden heads to global climate talks at the end of the month, weakened by infighting at home. He has embraced climate action as no other U.S. president has, promising to cut carbon from grids and shifting to electric cars. But U.S. negotiators at the Glasgow summit may have nothing to show other than promises of action. A down payment in funding to help poor countries fight climate change is unlikely to clear Congress this month. In China, factory inflation grew at the fastest rate last month in almost 26 years. The producer price index rose 10.7% from a year earlier. Coal prices and other commodity costs soared. That could add to inflation pressure if local businesses start passing on higher costs to customers. And 8 out of 10 British companies struggled to find workers last month, even though many are increasing wages. A survey by the British Chambers of Commerce found that labor shortages are getting worse. It forecasts that consumers will see further reductions in goods and services. So basically, Matt, there is a labor shortage everywhere, and while we were expecting it to improve, it's just not getting better.
Yeah, absolutely. You know, this is one of the things I ask myself when I look at what's going on in Washington. How are they going to fix the supply chain issues? Does it matter if you open a port at night if you can't hire anybody to work there? You know, you've got to fix the labor and the infrastructure problems before you're going to get the supply chain back on track, or the demand has to come back down.
Yeah, I mean, I think the UK is also quite specific because of a number of reasons. I mean, we have estimations that 100,000 European workers left because of the pandemic. So it's partly COVID, it's partly Brexit, and we see a shortage across the board, which you're right, Kelly, is symptomatic of things that we're seeing around the world, but just so much more in the UK because of the quirks of needing visas. So we have, for example, the UK government saying, look, I need 5,000 drivers, I need 5,000 poultry farmers, and they can come from like October to, I think, January. It's like a 3-month special visa, and they're trying to recruit right now.
Well, and it's an interesting question. We already have inflationary pressures in the UK coming from the power crunch you were seeing and higher energy prices that people have to pay. When does that start to be felt more in wages because of the labor shortage? As we said, people are already raising wages to a certain extent, and it's not bringing more people in the door. So do you have to go even further? And does that start to create more inflationary pressure that central banks have to really kind of get a grip on?
Yeah, that's $1 million question. Do you pay people more? Do you even have the staff, or are they actually in Europe or elsewhere? And again, the energy crisis is also because we didn't have enough drivers in the first place to bring them to the gas pumps. So it's like, you know, frankly, we're lucky we're not in policy to try and figure all of this out, Matt.
Yeah, well, I mean, of course, you can't not talk about Brexit. That's really the specific problem to the UK that exacerbates the problems we're seeing in the rest of the world.
Yeah, coming up, we'll talk about supply chains. We'll talk about maybe truck drivers with David Stubbs, head of investment strategy at JP Morgan Private Bank. This is Bloomberg.
They know me as Magnus TV in Facebook since I'm streaming Axie Infinity. Axie Infinity is an NFT game where you can earn tokens, and then that tokens can be converted into pesos. I'm playing almost 4 to 5 hours a day. I'm earning, I can say it's really a lot of money. It can help to sustain my family needs and also to sustain my own business that I'm starting. I'm a little bit worried about it because some people who join this Axie Infinity thinking that this is an easy money game. They can earn a lot on this game. This game can sustain their life. And I think that is not the point, or that is not really the game. We are trying now to build a community where other players or my scholars can join this esport, playing Axie Infinity for even 5 years, I think.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance, early edition. I'm Francine Lacroix here in London, Matt Miller in Berlin, Katie Lyons in New York. Matt, we're talking about supply chains, then we got distracted by donuts. But never mind, if you look at the supply chains, it's kind of undermining a lot of the recovery, but actually traders don't seem to care too much today.
Yeah, the supply chain and the labor shortage issues, they kind of go hand in hand. These are the big problems, you know, when you talk to especially small business owners. I talked to the NFIB's chief economist the other day, which is the U.S. National Federation of Independent Businesses. She said there's no end in sight for the supply chain and labor shortages, and that's a real problem for the economy. This is part of what's leading so many people to use the word stagflation.
Yeah, stagflation. Kaylee, markets are looking at the inflation numbers. Maybe at the margin they're worrying about tapering, but they're pretty strong today.
Yeah, maybe focused a bit more on earnings than on the inflation story, considering we do have 4 more big banks reporting over the course of the morning before the opening bell here in the U.S. Right now, equity futures are positive in the U.S. and stocks are positive as well in Europe. The Stoxx 600 actually up about 0.9%, being led by basic resources. In the bond market, we go nowhere on the U.S. 10-year Treasury yield. We are steady right at 153 after coming in 7.5 basis points over the last 2 days. And then feeding into that basic resources are higher in Europe is the fact that commodity prices are really higher across the board. You have WTI crude above $81 a barrel, and you're getting a lift broadly for some of the metals as well, and that has driven the Bloomberg Commodities Index up about 1% at its highest going back to May of 2015. No surprise then that you're seeing energy and material stocks getting a lift in pre-market trading. The likes of Diamondback, Devon Energy, Occidental Petroleum all up more than 2%, as is Freeport-McMoRan, which of course is a material stock, Francine.
Yeah, we'll have plenty more, of course, on some of those earnings. Joining us is David Stubbs, Head of Investment Strategy at JP Morgan. David, good morning. Nice to see you back in the studio.
Yeah.
When you look at inflation pressures, when you look at some of the monetary policy mistake that we could be looking at, is the more immediate effect actually on earnings and margin squeezed?
At the moment, we think that most parts of the equity market are going to be able to protect their margins because I think there's very good cost control in other areas. And I think also there's elements of what we think is a continued productivity surge in many places. We saw, Francine, during the COVID pandemic, the necessity to invest in a lot of digital tools. And I think that has laid the foundation for many companies now to support this expansion whilst protecting margins, even though some cost pressures are rising.
I was going to say, the energy prices, I mean, how much does that hurt companies across the world?
Not nearly as much as you might have thought, right? The energy intensity of GDP, how much energy you need to use to create $1 of GDP, a euro, a pound of GDP, has shrunken dramatically, more than 70% since the 1970s, right? That's one of the reasons why we're not going to see a very significant pass-through to headline inflation from the energy move too much. And of course, we know that if you look further out, the Bank of England, ECB, the Fed are all on record saying that a move in energy prices is ultimately deflationary. Why? Because it damages real wages, it sucks money out of everything else. You've got to pay for the gas, you can't buy anything else. That's why I wouldn't expect central banks to react too greatly to what should be a temporary move up in energy prices.
Well, we do see, though, markets pulling forward expectations for hikes, right? So does this give you an edge, David? Does this give you an opportunity?
Matt, I think the reason that you've seen markets pull things forward is actually confusion over the labor market, right? So what we have here, I think, maybe the biggest question in my mind for global economists is how much of this clear tightness you see in parts of the labor market is temporary, is artificial, because of COVID disruptions, because of lack of vaccines, because of lack of confidence, because of any kind of short-term removal from the labor market because people's savings are very high. All those things should go away. But if there's something else going on, some kind of major structural change, which is not clear what would cause that, which would remove big chunks of the labor market, and most of the people who've left the labor market are either very young or at the older age of the workforce, then that's going to change the calculus for central banks on how tight they can run the labor markets, how hot they can run their economies. That's the big question there. Matt. And until we see evidence of the labor force really starting to be boosted again and see people come back in, central banks are going to be questioning how far they can go.
Right. We may have to see wages continue to rise. As we were just talking about the UK, which is, has its own unique, some would say self-inflicted problems due to Brexit. But in the Western world, you're seeing everybody raise wages to try and bring people back to work. Are we going to see wages continue to beat expectations?
Look, I think for the next couple of quarters, absolutely the wage dynamics are going to be very strong because, as I said, you've seen labor supply shrink for a number of reasons during the pandemic. It's a little bit of a waiting game now for those people to re-enter the labor market. Obviously, higher wages will be a big part of that. I think there's also a battle for the future of work going on. There's a desire now for increased flexibility, increased benefits. I think it's kind of changed the perception of what work should be for large parts of the labor force, especially in the West. As that battle goes through, I think eventually you will see employers adjust. Not just on wages, but on other characteristics. And then these people will come back into the labor force. That will ease the pressure on wages as we move through 22.
Well, we've obviously seen wages going up, at least at the junior level, at a lot of the big banks because there's a real competition for talent out there. That's basically just a way of me getting to the fact that we're in the middle of bank earnings now, David. Would you be a buyer of financials here?
I think we still like where the financials are. Yes, we see a modest move higher in interest rates still coming. We know the strength of the balance sheets. We know the capital return story here. It's not just about dividends. It's about the very aggressive buyback plans by some of the large banks, for sure. But there's a limit to how far the reopening and cyclical trade is going to go. We're, I think, probably near the end of it than we are at the beginning. We might be taking off some of our cyclical recommendations as we move into the new year. But certainly for yield seeking investors, absolutely, financials are going to be a big part of their portfolio. And I think you have to look at financials now in the context of the challenge from fintech and the fact that some of these fintech companies are going to be able to take significant market share from certain types of banking opportunities. And that leads to some parts of the financials being vulnerable. That's why I think selection here is going to be very key if you're looking for a multi-year hold on some financials. Yeah.
David, thanks so much. David Stubbs, their head of investment strategy at JP Morgan. Now, coming up, we'll speak to the chief executive of European payment service provider Moli. He joins us live from the Investor All-Stars Conference. Our Tom McKenzie will be bringing us that interview. This is Bloomberg.
essa população é uma população importante, é uma população que frequenta a escola também, né? Então, é importante que eles também estejam protegidos para o coronavírus, evitando assim a transmissão.
Eu estava esperando muito por essa vacina. Desde o ano passado eu estava torcendo logo para poder minha vida logo voltar ao normal, que eu quero logo voltar para a escola, eu quero voltar a sair com meus amigos, eu quero sair, eu quero voltar à minha vida normal.
Foi toda administrada.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The growth story in cannabis remains very strong, even after the sort of loosening of the pandemic. There was a worry that there might be wallet spend competition, but so far the cannabis sector seems to be holding up very strong.
This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, Matt Miller in Berlin, Katie Lyons in New York. Now, the Investor All-Stars Conference brings together the biggest names in private equity with Europe's most promising technology startups. Joining us now from the conference is Bloomberg's Tom McKenzie, who joins us with the chief executive of a fintech firm. Tom, take it away.
Yeah, Francine, thank you very much indeed. Very pleased to say that I'm joined by the CEO of Molly, Shane Hapatch. Molly is one of the most exciting tech companies in Europe, frankly, in terms of the payments and processing of payments, rivaling the likes of Checkout.com and Stripe, backed by Blackstone, the valuation of about $6.5 billion. Shane, thank you for joining us before this conference here in London. Give us an update on the business in terms of the merchants. You service small, medium-sized businesses across the European space in terms of payments and ensuring that they have the software and technology that's needed. Where do you stand in terms of the numbers of merchants that you have on your platform and the daily additions that you're seeing?
Sure. We have about 180,000 active customers today, so that's a customer that's done a payment at some point in the course of the last year. We have about 400 or 500 customers signing up every single day, around 4,000 or 5,000 that become active in any given month. So still a huge tailwind. We're only in 5 countries as we speak, but we have a big plan and big ambition to grow beyond those borders.
And your business, your sector was one of those areas that was really turbocharged by the impacts of the pandemic. Are you still seeing that demand? Is that starting to ebb off at all, or is it remaining sticky?
Sure. I mean, I think there's a few people that pivoted very, very hard, right? So if you were a business that had absolutely no online strategy and you needed to engineer pickup and takeaway, or you had a restaurant and you needed to offer food delivery and so on and so forth. So you saw some really turbo prop customers signing up every single day, new business models, and some of that's ebbed off, but you do see some permanent changes in behavior. I think if you were the type that shopped in a supermarket and were forced to order your groceries online, I think some of those habits are now ingrained, I think, more and more, and so we've seen some growth just persist in some categories where people's buying habits have been permanently shifted due to the pandemic.
And you talked about that international footprint. I know that Asia is part of the focus for you as well as other parts of Europe. What are the priority countries right now in terms of expansion for Molly?
I mean, I think we have a lot to do for our existing customers. We're expanding in Germany, we're expanding in France. You know, we're in Belgium and the Netherlands. We're also going to enter the UK next year. So that's quite a big to do for us, especially if you want to make the product really sticky and do a really good job in hyper localizing it, which is part of our value proposition. I think, like all businesses, we dream of being global someday. So the product market fit definitely works in other parts of the world. So we're going to start to look further afield throughout the course of 2022.
Okay, so build out that footprint in Europe primarily, countries like Germany. But the US at some point, is that presumably a tantalizing proposition? Is it realistic?
Yeah, I mean, it's a huge market, right? It's my home market. I grew up there. It's very well served, I think, compared to certain other parts of the world, and very competitive. So, you know, we think our right to compete and win still has us focusing on Europe for the foreseeable future. But like all companies, you know, we want to be truly global. Eventually, at some point, you know, we'll have to make sure that we cater for every need, including where customers want us to be.
What themes are you seeing within the e-commerce space at this moment in time that are worth highlighting?
I mean, I think in general, like e-commerce has always been attractive. I mean, it's had many, many years of compound growth. I always think people are astonished by a couple of key stats. You know, one is that everyone assumes that about half the business is online, and in reality, in most European countries, it's sub 10, or maybe 10 to 15%.
Still sub 10?
Still sub 10, yeah. In the Netherlands, about 9%. The rest is retail. So, you know, we still have tremendous headwind, and you'll just see many years of digital substitution, as we call it. I think the other bit is fragmentation. So in the payment space, most people assume, you know, that some of these, the sexiest names out there, you know, some of the top 5 players in terms of global volume, but really about half the business is still held by 10 companies globally, and the other half is 5,000. You know, so we're in the 5,000, and we aim to be in the 10. And that means, you know, over time, the fragmentation will ultimately consolidate as more and more people just do a better job servicing a broader spectrum of customers.
Okay, so consolidation.
Yeah.
Does that start now? Are you starting to see it? Are you going to be involved? What are you looking at in terms of acquisitions?
There's been a lot of M&A and other activity, a lot of partnership too. So, you know, payments is one of those funny industries where your competitors might also be your customers, your distribution partners. So we all kind of cooperate in this big mix in order to try to get to the outcome. But consolidation will continue to play out, I think. In the long run, you know, the world doesn't need 10,000 payment companies, but it's not part of our strategy. We have a ton of headroom in our core market, and we're on a kind of organic build strategy, but you know, you never know. In many things, you have to talk to everybody. You have to make sure you understand what's going on.
So organic growth for the moment is a priority rather than acquisitions.
That's right. Yeah.
Okay, because you raised about $800 million in June, I believe.
We did, yeah.
Valuation of about $6.5 billion.
That's right.
And the priority for spending that cash?
Like anything, it starts with great people. So we're trying to build a world-class team. Most of the things that we need to do for clients are product and engineering led. So we're a product-led company, and we want to continue to be so. And you know, like everything, the investment and everything from cybersecurity to the latest technology to making a great web experience, you know, it's all capital intensive. So we want to make sure that we do a great job for our customers.
Okay, Shane, before I let you go, I've got to ask about IPO plans. How are you thinking about exiting from this business? Is an IPO a prospect in the next, say, 12 to 24 months for Molly?
Yeah, I mean, it's not the end goal of the company today. Right now, we have a great amount of work to do for our existing customers. I've been here for 6 months, so although that would be a phenomenal outcome in terms of time motion study, I think we're mainly focused on building the business. And you know, if that's the right outcome for the company at some point, so be it. But I was fond of saying, you know, our customers don't necessarily benefit from us being a public business. They're quite happy for us to focus on delivery for them, and that's what we're going to do over the next 12
Okay, so not rushing towards that IPO. The business was set up in 2004. You took over the helm as CEO 6 months ago. Shane Hapatch, thank you very much indeed. Guys, back to you.
Thank you so much. Bloomberg's Tom McKenzie there on our guest, Shane Hapatch from Molly. Now, coming up, Tom will be back with tech investor Carolina Brochado of EQT Partners from the Investor All-Stars Conference in London. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua in London, Matt Miller in Berlin, Kaylee Lyons in New York. Now let's get back to the Investor All-Stars Conference, where Bloomberg's Tom McKenzie is joined by another guest. Hi, Tom.
Hi, Francine. So a couple of minutes ago, we were speaking to one of the leading startups here in Europe. Now we're going to be speaking to one of the leading VCs and the partner at EQT, which is Europe's largest listed private equity company, Carolina Brochado. Make sure I get the name and the pronunciation correct. Thank you very much indeed, partner at EQT, formerly at Atomico, formerly at SoftBank in the Vision Fund there. I want to get your views to start with on what we're seeing in terms of VC funding for startups in Europe. It's been a dynamo of a year. At the first half, we saw about 50 billion euros pumped into startups across Europe from VCs. Do you think that momentum sustains itself? Are we at healthy levels at this point?
No, it's super interesting. And having been in Europe now in tech for 9 years, we've seen the capital invested in technology companies in Europe continuing to increase. But we are currently at the most rapid pace. So we're on track to hit 100 billion for the year from the 50, and that would have been 140%, I think, growth year over year in terms of capital invested in Europe.
And that's above the US and above Asia, is that right? I mean,
yes, that's right, in terms of growth. Yeah. But I think, historically, Europe had been very underfunded versus the US and Asia. When we first looked at it, when I was at Atomico in 2014, a Series A founder in Europe had 14 times less capital available to them than a Series A founder in the US. And so now that gap is narrowing, and more talent comes into the ecosystem, sees success, breeds success, and so you see the flywheel really spinning in Europe. So we expect, to answer your question, that we'll see more companies get to growth stage and get to greater and greater market caps as well.
Are you concerned at all about valuations with this amount of liquidity and this amount of funding being pumped into the startup scene here? Are valuations starting to look a little frothy?
Yeah, we always keep an eye, and it's hard because, some people have been saying that valuations have been high for 5 years.
Okay.
And so of course, you always look at the historical averages and whatnot. What we try to do at EQT, we're very thematic investors, is we try to understand the market and the trends, and how big an outcome can be, and whether we can make a return investing now or not. And I think the multiples today are what they are, and you can't really predict the future, but what you can do is you can try to really understand the company's position, the market trends, and then the execution abilities of the team.
And you're leading up the growth fund at EQT that was fairly newly set up. And of course, you've got the venture fund at EQT and then the private equity part of the business. What is the rationale then for the growth fund?
That's right. So the growth fund was a little bit of the gap, right, in trying to support entrepreneurs from seed through to growth and then beyond, because we also have a public value fund. And we were seeing a lot of actionable deal flow, companies like Klarna or Spotify that weren't buyout candidates, but were now too big for the early stage ventures business, but are fantastic businesses. And so with that, we are now one of the only platforms globally that can really have these different pockets of capital and dedicated teams that can create domain expertise, operating partners that are fit for purpose for the different stages, because companies will need different kinds of attention at different stages.
Okay, so where are the opportunities in Europe right now? What are you focused on in terms of turning that firepower into real value at companies across Europe?
Right, so we look at every geo, because we think that there's incredible companies coming out of every market. From a theme perspective, we are spending a lot of time on software companies, of course, a lot of time in fintech, and of course we invested in Molly, and you just chatted to Shane, and health tech. We see that there's a lot of potential there. And then we also spend a lot of time on what we call climate tech, which is really food tech and energy tech, where we think there's a lot of disruption potential, but still not a lot of capital being invested in those businesses.
And a lot of US funding is now turning their sights to Europe as well. Is that additional competition for you healthy? Do you welcome it? What do you think underpins that sentiment from the US?
Right, and actually, of rounds over 100 million, 90% of them were done by non-European investors. So the market today really is made up of US and Asian investors. We think that's exciting for us because we are the boots on the ground, and we welcome it because, you know, capital plus talent plus success breeding success really makes the ecosystem grow. And we think that there's still a lot more opportunity in Europe.
How much of this is about funds as well turning away from China, given the tech crackdown we're seeing there? Is that something you're seeing? Is that a material change?
We haven't really seen it yet, particularly in this asset class, but potentially something we'll see.
Talk to us about the capital markets. Is this a good time for a tech startup to be listing? Or would you advise your founders to hold off as growth looks and valuations look in the capital markets, arguably fairly toppy, and where we're looking at high interest rates longer term?
Yeah, it's hard to give a general answer because I think it depends. Some companies are ready for the IPO, and bear in mind the IPO is just a pit stop on a journey, right? It's just a different way to raise capital, and I think now there's, you know, with SPACs, right, there's more avenues for companies that perhaps aren't so traditional in what they're doing. But I think, you know, for some businesses, they're taking big risks and they can't afford to stay private longer and take those risks in private. There's advantages to that versus having to take those risks in the public eye. But it'll really depend on the business.
Okay, Carolina Brosado, partner at EQT. Thank you very much.
Thank you.
Indeed, on the insights in terms of what has been a very, very solid year for VC funding here of the startup space, tech startup space across Europe. Guys.
Thank you so much, Bloomberg's Tom McKenzie and our guest there, Carolina from EQ2 Partner. Now, it's a busy morning for banks today, Bank of America, Morgan Stanley, Wells Fargo, but also Citi all reporting. So we'll have full analysis and coverage as they break. Now, of course, if you look at a Citigroup, it's not going to be the same because a lot of the focus will be, for example, on the investment bank, much like Morgan Stanley, Wells Fargo. Maybe we have some regulatory things that we're waiting for them to come out with. Kaylee.
Yeah, regulatory definitely going to be a big thing for Citi and Wells Fargo, but for those more consumer-oriented banks, loan growth is going to be very important. We did see it up about 5% at JP Morgan, but it's been really hard to come by in the pandemic area. And for Citi, you also have to consider the credit card aspect as well. And then for Morgan Stanley, Matt, the bar is really high for equities trading because JP Morgan blew past what everybody was expecting.
Yeah, exactly. I think loan growth, you know, Jamie Dimon foreshadowed this problem last quarter, and so it'll be interesting to see how the other banks are dealing with it this quarter. But especially for our viewers, the trading aspect is going to be really important for shareholders as well as bankers who work in those departments because they're going to want to see big bonuses come Christmas.
Yes, and you know, they're very close with our customers, so maybe we could have a little bit of an idea of how much these high energy costs are actually weighing on margins and companies that they lend to. Stay with Bloomberg for full coverage.
from New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims front.
How are you thinking about those dynamics?
It's not really about whether banks beat or miss numbers this quarter. It's more about what's driving the beat or miss.
I think we're going to find out that companies still see a lot of top-line growth.
As the COVID problems fade away, I think that's going to be the real catalyst to bring everything back to normal.
There's a lot of concerns about growth. Growth is slowing, but it's still pretty solid.
It's either inflation or growth, and it looks like we're having a little bit of both.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
A big morning for bank earnings from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market up 30 on the S&P, advancing 0.7%. Four big banks on Wall Street, Tom Keene, reporting earnings a little bit later this morning.
If they report what J.P. Morgan reported, John, it's really going to be exceptional. There's no other way to put it. I look at the tape this morning. The and stagflation is being pushed aside. We're going to hear that from these banks.
It is CPI day 2. I say day 2, Tom, because one day's not enough to cover that CPI report. There is a lot of people who are starting to think about higher Treasury yields. Even Steve Major over at HSBC has gone from 1% to 1.5%. I get it. It's a tactical story for them. It's a 3-month horizon. But, Tom, you take note of that.
Well, you take note of it, and it's the only order of conversation down here in Washington at the IMF and World Bank meetings, the quality, the character of this inflation. John, we're data dependent. We're just going to have to wait to see what more inflation is. But you heard it, frankly, in the president's comments yesterday. It has political attention because the public feels, John, they don't care about the Dallas trim mean.
Of course they don't. You can't take out shelter costs. You can't take out food. You can't take out energy. Lisa, that T word is facing a bigger and bigger challenge going into year end.
The only person who I've heard who's actually sticking with it is Janet Yellen. Everybody else seems to have a swear jar, literally, to put some dollars in every time they say the word transitory. Look, yesterday, I don't think that we made enough about the rent increases. That is traditionally sticky. Every metric of rent going up dramatically in some cases at the highest pace since 2001. You can't strip it out, and it takes away from discretionary income.
There's a bid this morning, though, in this equity market. Let's whip through it. Up 30 on the S&P, advances 0.7%. Yesterday, we snapped a 3-day losing streak on the S&P 500. We add some weight to yesterday's move. Big banks reporting through the morning. Lisa will guide you through the times you need to put in your diary in just a moment. In the bond market, yields unchanged on 10s. We go through 160 back towards 150, 153.16, and euro dollar just about, Lisa, reclaiming a 116 handle. 116.09. You want to sit on that, Tom?
No, I want to sit on it. I think this is really important. There has been a sea change shift here away from the stag towards much more optimism. And I about fell off my IMF seat this morning looking at a VIX under 18. John, this just isn't a 1 or 2 day nuance. This is a shift back to growthiness.
My focus, though, Tom, not on 10s, it was on 2s. Lisa, we came really close to 40 basis points in yesterday's session on the very front end of the yield curve. That's where the conversation is for me. How sensitive will the Fed be to incoming data?
And the meeting minutes yesterday really illustrative of just how big this tension is, with the idea that perhaps they plan to end their purchases of bonds entirely by the middle of next year. This has a more hawkish tilt than we had before. We will see how much that helps the banks as they report earnings, how much it helps the outlook without necessarily a steeper yield curve, but definitely a higher front-end yield. It starts at 6:45 a.m., plus or minus. Bank of America kicking off today's bonanza of earnings. What I'm interested in, we're looking at loan growth. We're also looking at delinquencies. We're also looking at interest income. The fact that Bank of America is up more than 40% year to date. Same thing with Morgan Stanley. Wells Fargo up more than 50% year to date. Citigroup, up about 16%. What gives? How much can they outperform? Is this going to be basically the underperformer or the sort of the dog of the whole group trying to catch up? Or how much will this be a shift in market share? 11 a.m., I'm really closely watching this. U.S. is planning to release crude oil inventory data. This, to me, is one of the biggest stories as oil prices climb to the highest levels since 2014, especially as the IEA comes out and expects a deficit in total oil demand, in total oil supplies, I should say, through the end of this year, actually deepening more than they had expected. How much can the U.S. compensate for that? And at 8:30 a.m., again, you say CPI continued. We get the PPI, the producer price increases, index increases for the month of September, following what we saw over in China. The biggest increase in factory prices going back 26 years, John. This is commodity prices biting, and it's their inability to pass it along to the consumer that's really bleeding into some of the economic projections for the economy over there.
The first thing I looked at about 2-something this morning when I woke up, and Tom, you came back from wherever you were coming back from. China PPI picking up in a big way. Let's talk about dollar lira picking up in a big way. That currency pair through 9. Tom, through 9. Lisa, your comment on this, please. The president of Turkey firing 3 policymakers, and seemingly this market now set up for another interest rate cut, even though CPI is approaching 20%.
In the commentary in the article, they talked about the non-traditional approach to monetary policy, where you think that rate cuts are actually going to reduce inflation. There is very little in terms of academic research that seems to signify this, and that's what you've seen, record weakness in lira, as basically they look at the determination of Erdogan to have lower rates, even if that really doesn't actually mean lower borrowing costs, because who is going to lend to Turkey right now, John?
That's a big question. We're going to find out through the months ahead to see if they do cut interest rates once again. Lisa, thank you. Some comments from Christine Lagarde of the ECB. It is critical that policy support is not withdrawn prematurely. A rebound phase of the economy is increasingly advanced. The risk to the Eurozone growth outlook is broadly balanced. So far, no evidence of second-round effects, Tom, on inflation. The view from the ECB president this morning.
Second round effects is one of the weakest phrases in economics. It's something you bandy about, John. When you don't have concision, you don't have acuity. I'm going to be blunt, John. Is second round the new transitory? It's just as simple as that.
Well, when you catch up with the ECB president, if you see her, Tom, in and around the halls of the IMF World Bank meetings, maybe you can say that.
We'll discuss second round after the second beverage.
After the second round. Jack Ablin joins us now, Crescent Capital founding partner and CIO. Jack, Kit Jukes' SocGen just dropped a note in our inboxes. Have we priced in enough Fed action for now then? That's the question for me this morning, Jack. Do you think we have?
You know, it's interesting. I would say that the surprise is going to be more aggressiveness. I've operated under the assumption that the Fed is, pretty much sitting on the couch and watching this play out, that they've wanted to see inflation rise. They wanted a little more wiggle room for policy. So to come back and say that they're going to end tapering and buying altogether, I should say, middle of next year, to me is a surprise. That is a hawkish move.
Jack, Jim Suva published detailed notes on Apple Computer this morning. He's out to 170, up 20%. I went into the cash flow model that he has. These things are cash flow juggernauts, and they hinge on a growth economy. Are we in this moment repricing away from the gloom back towards some kind of stable growth?
I'd love to get there. I just don't see an easy path from where we are to what has been laid out there. We have to get past some of these shortages, and I think that's probably embedded in that or implied in that note. So yeah, if we can get beyond these shortages and actually move forward, there is growth there. Meanwhile, of course, you've got essentially 3 sources of production, right? You've got labor, you've got capital, and then you've got kind of these commodity inputs. And right now, labor and commodity inputs are crowding out capital.
And Lisa, Jim Suva adjusts for that, the China issue and all that with the iPhones.
Well, this is the issue, though, that as we get some of these earnings from the big banks, typically they are indicative of the economic projection. This time, I wonder, and I especially want to dovetail this into the Apple story, supply chain disruptions are affecting those that produce products, not so much the banks. Jack, how much are banks actually indicative of the economic cycle, given their somewhat immunity to some of these pressures that we're seeing pretty broadly?
Yeah, that's it. I mean, my main concern, particularly with earnings and margins, is not financials, not necessarily tech. It's going to be consumer discretionary, consumer staples. I mean, look at a company like Dollar General. That company is really caught in three trends that are working against them, right? So it's one is they've got to maintain this dollar price, which is difficult. Two, they're trying to attract workers at $12 an hour, where Walmart and Amazon are paying $17. And then they're trying to get product. A lot of their product comes from overseas, and either it's delayed or not even available. So that's the companies like that, where there are a lot of labor for the amount of market cap that they have. Generally, the consumer side absolutely under pressure. Meanwhile, financials, it's ideal conditions for financials. Net interest margins, loan loss reserves. I mean, credit conditions are incredible. And I'd call credit conditions the North Pole right now. I just don't see how they get any better. So I think from a financial bank investor point of view, you go, great, let's put, Q3 in the cash register. But then we got to look forward and say, what's going on from here?
We've got to look forward too. Jack, we appreciate your time, sir. Jack Hamblin of Crescent Capital. Coming up a little bit later this morning, Lisa ran you through the next couple of hours. 6:45 a.m. Bank of America, 7:30 Morgan Stanley, Citi at about 8 a.m. For a lot of people, Lisa, they talk about the banks as a haven away from the supply chain issues. When you speak to the bank analysts specifically about loan growth, they'll tell you this story that companies can't get access to inventory, so they're not borrowing money to buy it. That's what we need to see fade to get those loan books starting to build up again. That's just one theme, one little theme, but something worth focusing on.
But the interesting thing is it's not just the companies. We're not seeing any loan growth in consumer lending, in the consumer sector. The idea here that they're flush with cash, they don't need to be borrowing. How long is it going to take for them to bleed down some of those savings pools? And without that, how much income can they really earn, the big banks, given how low rates are and how much demand there is for debt?
We've just had one of the biggest fiscal transfers in economic history, and we're still working through it. Tom Keene, 7:30, Morgan Stanley, I know, gets your attention.
It's front and center. James Gorman hit the ball out of the park this time, that time, and the time before it. I'm fascinated to see if he can carry over asset management excellence to the rest of the company.
Before we get there, 7 a.m. Eastern Time, Mohammed Al-Arian, the big conversation for us this morning. There is a real challenge to the transitory story of this Federal Reserve. Your equity market up 29, advancing 0.7%. This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. Last month, Federal Reserve officials agreed they could start reducing emergency support for the economy in mid-November or mid-December. Minutes of the policymakers' meeting showed that there were increasing concern over inflation. Most participants saw inflation risks weighted to the upside. They also discussed whether labor supply would bounce back to 2019 levels. Now in China, factory inflation grew at the fastest rate last month in almost 26 years. The producer price index rose 10.7% from a year earlier. Coal prices and other commodity costs also soared. That could add to inflation pressure if local businesses start passing on higher costs to customers. In Turkey, President Recep Tayyip Erdogan has fired monetary policymakers opposed to cutting interest rates further. Erdogan's midnight decree drove the lira to record lows against the dollar. The shakeup paves the way for him to exert greater influence on the central bank's policy-making panel. The European Union and the UK are braced for a new round of negotiations over trade barriers in Northern Ireland, but there have been glimmers of progress. The EU has offered a set of adjustments to the Northern Ireland Protocol. It would slash customs checks into the territory by half and cut sanitary inspections on many retail goods by 80%. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
tinatanggap ko po ang inyong nominasyon sa akin bilang kandidato sa pagkapangulo ng Republika ng Pilipinas. I am a fighter, and I will always be a fighter inside and outside the ring.
Bloomberg surveillance to learn how to look at markets, how to look at trends, and how to look younger.
What do you think, John? Botox, or do I really need to get something done?
I think, Tom, if we just change the style up a little bit.
You think so?
Yeah,
You
drop
look great.
the bow tie. Drop the bow tie.
What,
Drop
skinny
the bow
tie?
Yeah. I always say, this is my line, whenever anyone in America has a go at me about a skinny tie, the older you get, the wider it gets.
Oh, really?
Until it becomes a bow tie.
This is a bow tie.
Until it becomes so fat, you just sort of...
How is Ireland dealing with that blackout risk, those energy prices spiking?
Well, in the first instance, we will manage it over the next while. I think the key agenda item for Ireland on the energy front is wind, and we've been great developers of onshore wind. The next decade in Ireland will be offshore wind, and we have streamlined our planning application framework for investors so they have certainty in terms of applying to invest in terms of offshore wind infrastructure in Ireland. So that will be a key agenda item of ours. And renewables. We have a very strong climate component in our government and in our government programme. And that, of course, is not disconnected from the energy agenda. And there will be challenges of that, there is no doubt, but we are making considerable progress.
Are you worried about the here and now? Are you worried about blackout risks? Are you worried about the amount of consumption data?
Data is taking up considerable demand in energy terms, but we have been robust in terms of meeting that to date.
How far will the Bloomberg surveillance team go to get the inside story?
The UK will deploy its reserve tanker fleet this afternoon.
There we go.
Tom McKean and I might be part of the reserve fleet
We might be.
that gets deployed.
This is more complex than people think. The steering wheel's on the wrong side of the truck. That's the first thing.
Oh my God.
Thank you to the gentleman out on Twitter that captured this moment.
Wait, question.
Wonderful.
Who of you has a driver's license?
You don't need that.
The word I would use here is resilience. We simply have to build much more deeply resilient supply chains. That's certainly the goal that he set out for our supply chain task force.
Jared Bernstein there, the White House Council of Economic Advisors member, sitting down with Tom Keane yesterday from New York City. Sitting down with Tom Keane today, Lisa Abramowitz and Jonathan Ferro. Your equity market up 29 on the S&P. We advance 0.7%. There's a nice lift here in about 20 minutes. Call it 30. We get numbers from Bank of America, then onwards to three more banks through this morning. In the bond market, yields unchanged, 153.51. That's a big turnaround. This curve has been flatter the last couple of days. In the commodity market, crude back with an 81 handle on WTI, 81.32. Tom, a lift again. Crude up more than 1%.
Yeah, I'm glad you mentioned crude, John. 84. We're not up to the new record high, but 84.16 is right buttressed up there, a little bit away from bursting through. That'll be interesting to watch. You mentioned Turkish lira early, John, and I'm just going to go to a more... John, I see a more constructive tape. Do you agree?
Do you? Today, yeah?
Yeah.
There's a lift,
Yeah,
Tom.
I do.
I mean, I see a
can't
lift,
get
if
the
that's what you
gloom
mean.
going.
I don't know if the gloom's faded away, Tom. After that CPI report yesterday, I don't think we've settled anything going into year end, and I don't think the data's going to settle anything for the next 3 months either.
The VIX under 18, 17.82. Okay, here's the reality. John Ferro eats Marmite, which is unedible. Worse is Vegemite from Australia. And what you need to know after hearing the President of the United States yesterday is the LA Times says it's $100,000 a year plus for the longshoremen unloading the Vegemite in Long Beach in LA. He hates both Marmite and Vegemite. Jack Fitzpatrick joins us from Bloomberg Government. I was surprised. I mean, I knew he'd center on labor, but I was really surprised how the president really focused on a labor message. Discuss that.
Yeah, they had to get labor unions involved in the conversations around that. They still have some work left to do. Actually, one of the criticisms of the work they're doing with 24/7 operations at ports is you need to align that with trucking. And if there are truckers waiting and parked for a long time and not getting paid for that, that is one outstanding issue that has been raised. So getting a variety of stakeholders together on this has really been the president's only option, because that's his role. This is not federal dollars paying for this.
We call that doing a United Kingdom. John and I actually personally experienced that on a road trip here recently on trucking in Britain. Labor votes for Biden, do they?
Yeah, typically Biden performed more strongly among labor groups and probably in that demographic in 2020 than what we saw in 2016 from Clinton. There was a push to try to sort of get a better Democratic stronghold with labor after the 2016 disappointment. Can he hold on to that? That may be subject to broader economic issues that could push back against Democrats in 2022.
Jack, I listened to President Biden's speech yesterday and heard some of the proposals to try to ease up some of the supply chain kinks. And yes, it was very political in nature. Aside from that, he proposes keeping ports open longer, adding more workers. Does anyone actually think that this will work at a time when supply chains are increasingly complicated and depend on all of these specific variables, not all of which can be fixed by President Biden?
Well, yeah, you're getting at the key issue here is that this is a bit of a piecemeal approach. It's not a holistic federal government solution to the problem. It's one piece of it. And again, that criticism remains that they still probably need to do more work on trucking. The White House has said this is going to be part of about a 3-month push. They're trying to, in the next 90 days, come up with more solutions, more agreements with private companies on what they can do to try to make progress by the end of the year. But I don't even think that the president necessarily was casting this as the end-all, be-all solution, or at least it wouldn't actually seem to be the final solution to these problems.
Jack, can you paint this in the broader discussion of infrastructure spending? Is this being used, the whole supply chain disruption, as an argument for why we need more investment to fortify some of these supply chains, to fortify the shipping and the infrastructure, or is it being used as evidence to not spend more because it is fueling inflation and this is hurting the consumer?
When I've heard it come up on Capitol Hill, it's typically been used in favor of, these are some of the issues that we would like to address. We need an infrastructure bill. I will point out, though, that since that infrastructure bill has already gotten through the Senate and looks to have a glide path, essentially, when the Democrats finish up their other bill, nobody's arguing against the infrastructure bill at this point. There's no reason to do that. So it's positive words about that.
I look, Jack, at where we are now in this government, and with the battles that we have on surveillance about inflation, about the economy and GDP as well. What's a sweat factor now? I mean, it's only coming into Thursday, but they got to get to the Sunday talk shows and message there. What will be the administration's message there to a really fractious Democratic Party?
It seems to be trying to put supply side issues that contribute to inflation into plain English. When you heard the president speak in his speech, going out and saying, you may have heard of something called the supply chain. This is a pretty complex issue that doesn't lend itself to campaign politics very easily and explanation. So trying to just introduce that concept that the inflation we're seeing isn't just because you got a stimulus check. There's all of these supply chain issues, which is hard to communicate for the White House. Can
Republicans, obviously Republicans are going to say this is President Biden's fault. Does that stick?
It may stick. We have enough time before Election Day 2022, but there seems to be a lot of confidence on the Republican side that this is a strong issue for them.
Jack, thank you. Jack Fitzpatrick there, down in Washington. Yes, Tom?
I'm watching On the Waterfront tonight. I gotta watch in.
What's that?
That's a movie, 1954. Marlon
Yeah,
Brando.
I wasn't around then, Tom. Did you watch it as a kid when it came out?
I watched it 42 times.
Were you in the
A
movie
blonde
theater for
showed
that
up.
one? Were you there
A
for the
lovely,
premiere?
lovely blonde showed up early in the movie.
Do you want to get yourself in trouble here?
You were transfixed.
I was transfixed. Speaker Pelosi, Tom, says you should do a better job of selling this package down in D.C. Her words. I think you could do a better job of selling it, to be very frank with you. Should we do a better job of selling it? Is that the problem here? The reporters, the media, the press aren't doing a good job of selling their package?
I don't know about that, John. That's a good question. It's a really, really good question. What I would suggest down here, and, you know, Jack and Anne-Marie Horton and the rest of them are on this 24/7, I hear almost a silence on the linkage of these two bills. It's sort of drifted away.
Lisa, it's drifting away into a new year, except they need to get it done.
Okay, it's not fair to put it on the journalists to be an advocate one way or another. Frankly, that is not our job, and that is number one. But number two, this is the issue. What are you selling when the Democrats can't get on the same page as to what they are trying to spend on? I mean, the details have not been worked out. We're discussing the headline number, and yet this is to even begin the conversation of which programs to fund. This is part of the issue.
Many issues. Lisa Bramett and Tom Keene. Jonathan Ferro, your equity market, that's three of the issues. Up 28 on the S&P, up 6/7 Yields unchanged on 10s, 153.
I missed my entry
16.
point.
You think this is it, Tom? You think we've worked through the chop already?
I find the gloom crew stammering. They're
trying to get a call from him.
to justify weak GDP. Maybe that'll happen.
Okay, Bank of America numbers around the corner. Good morning to you all. This is Bloomberg.
China's growth because it is already slowing. Chinese manufacturers are curbing production. This is the latest shock to global supply chains, already delayed by, port delays, chip shortages, saddled with soaring commodity prices as well.
Well, Haslinda, when we've seen a lot of supply chain disruptions at the beginning of this COVID pandemic, and then, supply chains became resilient and it really moved goods around, especially medical goods and supplies. But now, at this part of the pandemic, we are seeing disruptions again, and discontinuities. And that is because of what we spoke about, the demand that is pent up. And of course, if you have factories slowing down and, not being able to produce as much, that is going to impact growth and the recovery.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
I think what we've seen during this period of time is that communicating via video is not a fad. That we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Live from New York City this morning. Good morning. This Thursday morning, the price action shaping up as follows. Equity futures up 28, advancing quite nicely, up 0.6% on the Nasdaq, up 0.75%. Similar story, same story on a Russell to small caps. A real lift here going into the bank numbers, which begin in about 15 minutes. Let's start with the bank's pre-market. Switch up the board. Pre-market shaping up as follows for the likes of Bank of America, Morgan Stanley, and Citi. Waiting for those numbers to drop. That starts in 20 minutes. Bank of America in the pre-market up 0.4%, but since September 22nd, once we really started to have this conversation, a bit more so, about higher interest rates, Bank of America's up about 10% coming into today. So let's talk about rates. Switch at the board and get to the bond market. 2s, 10s, and 30s. 2s is what I want to look at here, Tom. 35 basis points. Yesterday coming really close to 40. This is the rate hike dance now coming in. It's getting pulled in just a little bit more.
Where to? Where to? Are we in autumn of 2022? Is
For
that
me,
your
Tom,
basic
it's not about
feeling?
me. Deutsche Bank is out in 22. Ibrahim Rakbari of Citi thinks that this Federal Reserve is going to be increasingly sensitive to this inflation story, which will persist. And Lisa, what was curious about yesterday, in fact, not just yesterday, but the day before, the amount of demand we've seen on 10s and 30s when that supply's come through has been really remarkable.
Yeah, well, and this to me highlights the sort of dissonance between the rate hike and the longer term trend. The sooner the Fed hikes, the less longer term inflation has to pick up, John.
Appetite for 10s, appetite for 30s, sell off on 2s. What do you get, Tom? You get a flatter curve. That's what we've seen. 10s right now, 153.34. Yields basically unchanged.
Yeah, zero hedge featured yesterday, 2s out to 30s, which is a different curve. It's a short-term Fed angle and a long-term view as well. And there's some real dynamics there. I do take the point, John, that away from the vanilla curve, 2s to 10s, there's some interesting nuances going on.
You can take your pick. The curve's flatter. For the banks, Tom, and I think this will resonate with you and it will resonate with Ken Leon as well. For the banks, what really matters is the very front end. Yet there's this media narrative that everything tracks 10s. And it starts to matter because so many people believe in it. But for profitability for the banks, Tom, it is all about the front end.
Yeah, and I would say not only the profitability, as we saw ginormous profits from JP Morgan yesterday, but the quality of those profits. Let's touch into this before Bank of America. Kenneth Leon, CFRA, their research director, thrilled he joins us on these earnings days. Ken Leon, the character of JP Morgan's profits, do you adjust it for the reserve dynamics, or do you say, boy, those were quality profits, boy, we're going to see quality profits this morning?
So we still may see loan loss reversals, and that really isn't normalized earnings or the outlook for the banks. And that's going to taper to be near zero in 2022. So it's all about the business. It's about volume, activity, and to the point of the labyrinth of getting through rates, rate rise to net interest income. It's complex for general viewers, but it really matters because it's 50 to 60% of total net revenue has to do with rate. So I think the big themes today from four banks, and Tom, this is the first time we've seen this maybe in 10, 15 years. Why are they all loaded up today? But it's about the consumer and it's about velocity. And do consumers really want to borrow or have these large loan balances because they're flush with cash?
Ken, talk a little bit more about that. We saw yesterday with JP Morgan, there was a little bit of life in the corporate lending sector. There was zero life when it comes to the consumer lending sector. What do you have to see to get more bullish in some of these banks?
Yeah, it's a great question, and we did see constructive on the commercial side, but it's moderate. It's really having a bigger rate of change for the consumer. I think Mark Mason, who spoke, he's the CFO of Citigroup, will speak again, saying he sees normalization of consumer loan balances, and this is the credit cards, will happen later this year. However, pandemics change behavior, as we've already seen, and consumers might be worried about job retention, and also it's a new world. Also, we're going to have this conversation, if not today, in the future, about consumers now with fintech have the ability to do BNPL, buy now, pay later, in unsecured loans, whether it's buying a Peloton or whatever, pay it off in 3 years, and have zero interest rate. And I just checked the Fed, by the way, today. The average charge on credit cards is in the mid-teens, 15 to 17%, which is obscene.
And that's the reason why people are looking to new ways to get credit for their purchases. Ken, this is sort of a difficult question, but how far out are investors pushing their expectations, their earnings for some of these firms that they're investing in? And I ask this at a time when we're bringing forward so much of the hope for increased loan growth, and people are actually giving a pass to banks that are showing no sign of it as of yet.
So it's like the famous novel or show, Waiting for Godot. Analysts are usually ahead of investors about saying rates are going to have a strong impact on the recovery for these banks, and we're going to model that in 2022 and 23. It usually gets moderated as we get every quarter where they report. So, when you look at the mechanics of things like earnings yield, spreads, net interest margin, or NIMs, all this stuff, it's moderate. For JP Morgan yesterday, most of those metrics were flat quarter over quarter from the June to the September quarter. It's going to take time. But you need volume. If you're not going to get it in rates, which is an easy pass for the banks, and even portfolio managers want to buy these banks for that reason, you need volume, which is the strength of the economy and participation of the consumer.
Ken, we get the numbers in about 9 minutes' time. Once the numbers come out, we'll spend a ton of time on big figures, big numbers, and we'll get knee-deep in that. It'll be a big distraction. Before we get there, you mentioned something I think is really important, fintech. These companies, these stocks have re-rated. As someone mentioned yesterday on this program, it's the one area of the equity market that's actually got more expensive through the year. I'm just wondering whether fintech actually caps the ability for these stocks to re-rate much higher than they already have, Ken. What's your take on that?
Perhaps. I mean, fintech does two things. One, it's possibly a disruptor that's a threat to their established businesses, particularly in consumer banking. Or second, it's a leverage with technology, and they acquire tactically businesses or technologies that help them augment processing and improving their bank, which means improve margins and profitability. So they always use technology. Jamie Dimon always speaks to this, but it's this whole notion that the millennials or the Generation Y behavior is changing, and whether banks, given their scale and their embedded costs, can have the same pivot as a new startup. Unsecured loans is going to be the theater over the next 2 years, and why should we pay 15 or 17% on a credit card just because maybe I was furloughed for a month or two or longer? That's going to be the big area, I believe.
Ken, stay close, won't you? We're going to break these numbers down with you, and luckily we'll have you through the morning. Bank of America in about 5-10 minutes' time, then on to Wells Fargo, sometime between 7 and 8 a.m. Morgan Stanley, 7:30, Citi, 8 a.m. Lisa, fintech, this is a big issue. I can see Sonali Basak out the corner of my eye again. She's in the building, getting ready to break down these numbers. Sonali, I know you can do the compare and contrast as well, and I think this is important. PayPal, we're looking at what, 300 billion market cap right now?
Yeah.
What's Citi at? Half of that?
Less than half of that.
What does that tell you, Sonali, about where these banks are positioned at the moment?
It was really interesting to hear Jamie Dimon name check a firm during the analyst call yesterday. Call them out by name by saying not only are they doing buy now, pay later, they are also getting into more credit products. And he said he would spend anything he could in order to be able to, meet the competition. So it's interesting to see, Jamie Dimon has done a ton of acquisitions. Let's see if that kind of demand exists for the others when there's so much pressure on margins. There's a lot of pressure on costs, John.
Sonali, the Bible here is the late, wonderful Clay Christensen. He was a wonderful friend of this show. and the innovator's dilemma. Can Brian Moynihan do Clay Christensen? It's just that simple. Can they co-opt modern banking technology?
It's funny that you asked that because, Jim Bianco, I know you have a lot on yesterday, was online yesterday saying, is the answer here for JP Morgan to be buying something like a Zelle? And how creative of an answer is something like that? It's a tough situation here because you don't just have fintech, you also have, cryptocurrencies, but blockchain being adopted at a very fast rate, Tom, by folks like Apollo and KKR and other major credit providers to this economy. So are the banks going to also invest in those technologies?
John, I would kill to talk to Brian Moynihan about this over a beverage of his choice. To me, this is just absolutely arch. With Moynihan, it would be a Narragansett lager beer. But John, this is serious stuff. Can they do what the wonderful Clay Christensen talked about? I'm hugely skeptical.
Elisa, this is the question, one of the big questions for this industry right now.
And whether they have the capacity to do it, they certainly have the cash. But Shonali, do investors reward the banks? Have they been rewarding them over the past few quarters for making investments that are risky but are looking forward?
At the end of the day, these are strapped by regulatory constraints also. There's only so big they can do acquisitions. They're all tuck-ons. Yes, we've had a run up in their stock price, but not as much as the fintechs by and large, and not as much as their private capital peers. So you're seeing this huge divergence when it comes to the way capital markets function today.
Shonali, sit tight. The numbers are moments away for Bank of America. Shonali will help us break that down. We'll get the thoughts of Ken Leon a little bit later. Stephen Bigger of Argus Financial Institutions Research. The story here right now in the equity market, up 29 on the S&P, advancing around about 0.7%. There's a lift out there at the moment, Lisa. A little bit of a lift. There was a lift yesterday too. Keep going back to this story though with CPI. It really is for me CPI day 2. Then it's going to be day 3. The Federal Reserve can't get away from this now. It was really plausible to talk about the story that they were pushing. I wonder whether this is not just a balance of risk story now for them. This is not just about upside risk, that you have to maybe adjust your baseline as well. To what extent do you need to do that?
You're starting to see a broadening out of the inflationary pressures, and the inflationary pressures are stickier when you start to talk about higher rent.
Mohammed Al-Arian joining us in about 20 minutes' time on this. Got an idea of what Mohammed thinks about the moment we're in right now. I'm looking forward to the refresh just around the corner. Equity futures up 29, advancing 0.7%. It is earnings season, well underway on Wall Street. This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. President Biden is heading to global climate talks at the end of the month, weakened by infighting at home. He has embraced climate action as no other U.S. president has, promising to cut carbon from grids and shifting to electric cars. But U.S. negotiators at the Glasgow summit may have nothing to show other than promises of action. A down payment and funding to help poorer countries fight climate change is unlikely to clear Congress this month. Now, former Treasury Secretary Larry Summers is blasting the Fed for risking losing control of inflation. Summers said there is a generation of central bankers who are defining themselves by their wokeness. He said they are paying too much attention to social issues and not enough to the biggest risk of inflation since the 70s. The White House has once again said it won't support former President Trump's assertion of executive privilege over records related to the January the 6th insurrection. It has ordered the National Archives to turn over documents to congressional investigators within 30 days. The former president has indicated he might start a legal challenge to keep the records shielded. 8 out of 10 British companies struggled to find workers last month, even though many are increasing their wages. A survey by the British Chambers of Commerce found that labour shortages are indeed getting worse. It forecasts that consumers will see further reductions in goods and in services. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
Live from New York City for our audience worldwide on TV and radio, this is Bloomberg Surveillance, and here are the numbers from Bank of America. Equity trading revenue. This was strong at JP Morgan. It's decent at Bank of America as well. 1.61 billion, the estimate 1.41 billion. We understood there'd be some weakness on the FIC side of things. It's actually a beat over at Bank of America for the third quarter. FIC trading revenue, 2.03 billion, the estimate 1.86 billion. We get the revenue for investment banking at 2.17 billion. Net interest income, 11.2 billion, the estimate there, 10.65 billion. Widely expected here, and then a reserve release. We've had two big quarters of this. We saw this at JP Morgan. We now get a third as well at Bank of America. The third quarter including a $1.1 billion reserve release. As for the stock, up more than 10% from September 22nd into this morning. We're up about 0.8% off the back of this at 43.48. Just to read us some of the numbers there then. Trading revenue, 3.63 billion, the estimate 3.27 billion. Shonali Bassett with us to help us break this down. Shonali, your first read on this. It's a nice little beat.
Really nice beat in a lot of different business lines. That net interest income came in well in above expectations, which you have to parse through the numbers there. Where are we seeing the most activity? And what does that look like into 2022? It's very good news for Bank of America. That fixed income beat, that equities beat, advisory beat. You have a lot of strong numbers in the investment bank as well. This is one of the best reads I've seen for Bank of America in a long time in terms of how much they beat market expectations. And remember, Bank of America has had a lot of change at the top, a lot of turnover. And so these executives are walking into a pretty clean slate, John.
Shonali, I want to hone in on the net interest income. A lot of people had lowered their expectations. We saw JP Morgan basically in line, a little bit lower than expectations. Do you have any sense of how big of a deal it is for them to beat by the degree that they did in an environment with lower yields?
I mean, it's breathtaking. It was $10.6 billion was expected. Remember, last quarter they had fell shy. Brian Moynihan, his executives have been telling the street that by the end of the year, they could get $1 billion more in net interest income. But, you know, you saw JP Morgan's print yesterday. There's still a little bit of sluggish growth when it comes to the consumer. So where is that growth coming from? Again, the mixture of Bank of America's business is a little bit different. When we look at Citigroup a little bit later, very, very card heavy, and that's one of the businesses we're concerned about. But again, sustainability of this business, I think it comes to mind as mortgages when I think of Bank of America as well. If rates start to rise, then how are these businesses impacted? Deposits still growing, although now that loans are as well growing, we'll be watching if that ratio starts to turn such that they have less pure cash and more deployment of that cash.
Shonali, for Brian Moynihan, it is a Boston Bruins hockey stick. I don't know which player, but we'll go with it. Vivi Chari is long gone. And the answer is the efficiency ratio really begins to get back to a nirvana from another time and place. They've gone from 71% efficiency ratio to a stunning 63. All you need to know, folks, is that's really moving in the right direction. Shonali Bassett, is this a new Bank of America?
It's getting there. It's still the same bank, Tom, in that they probably have a lot of technology investment they need to do, as we've been talking about. The efficiency ratio for the 3 months was 52%, which is a lot more in line with what investors like to see. Once you get past 60, we don't love it, right? And so they have been bringing those costs down. Now the question is how they can sustain that. Remember, Bank of America is one of the firms that had really committed not only to minimum wages, but pressuring their suppliers to also increase their minimum wages. So that wage pressure, I know we're hearing from Brian Moynihan a little bit later today, that wage pressure on margins at the end of the day is a question.
Shonali, one down, here's another one. Wells Fargo, let's work through this together. Wells Fargo third quarter EPS, $1.17. Revenue comes in at 18.83 billion. The estimate 18.4. Total average loans, a number we get from Wells Fargo, $854 billion. So just some of the numbers from Bank of America this morning, Tom. Some of the numbers from Wells Fargo too. Some commentary from Paul Donofrio, the CFO of Bank of America, in the press release. We grew revenues faster than expenses, producing year-over-year operating leverage in every business segment and 12% for the company. Net interest income improved despite a challenging rate environment. That was Lisa's point. Just looking at Wells Fargo, Tom, negative there about 1/10%. Revenue 18.83, the estimate 18.4 billion. And a quick look at Bank of America in the pre-market, if we can as well, if we can bring that up on a screen for our audience, Tom. I'll do that on my terminal while I'm still talking. In the pre-market, we look a little something like this. 43.89. up by 1.74%.
I really want to emphasize, John, these are two different banks. To the
Very much so.
non-sophisticates like me, we bundle them all in together, and I really, folks, can't say how Wells Fargo has separated away from these other banks. They've all got their own stories, they've all got their own foibles, etc. But John, to me, Wells Fargo is removed. Ken Leon's a lot better at that than any of us are. What else do you see, John?
That's about it. So let's get to Ken, Tom. Ken Leon,
Ken Leon, help us right now. What is the Wells Fargo distinction here? How separate are they from Bank of America, J.P. Morgan, and indeed Citigroup?
Well, they're handcuffed with the Fed asset freeze, which really limits their ability to grow assets. So they have to be selective where to get the best profit or return. For investors, though, Tom, I got to disagree. I mean, Bank of America, it looks like a clean quarter. Everything's firing on all cylinders for the most part. Wells Fargo, you got a bigger delta opportunity if they can improve businesses. Yes. With Wells Fargo, the velocity of mortgages, especially refi besides origination, is a big engine for Wells Fargo. And they got another big delta on the card business. They still have a national platform for the consumer. So it's not always who's the best and who's the worst, but who is changing, and that's what investors need to capture. Bank of America's a great company, but this is their first clean quarter, as noted earlier, versus the last few.
So just to be clear, Ken, it sounds like you are more bullish on Wells Fargo from here as an equity investor than Bank of America. Is that correct?
That's correct. So I haven't seen today's results, but essentially when you have turnarounds and you're in kind of like the end of the second quarter, which Wells Fargo is, they're in a position where they can show significant increases in businesses that have underperformed for several years. They got a new management team in place that took several years to, and when you look at playing the banks and playing net interest income, you really should look at Wells Fargo besides a Bank of America. And when you look at quality, the Wells Fargo franchise is not going away. So turnarounds are never pretty, but I'm sure we're going to hear that narrative later today on the call.
Ken, I want to dig a little bit deeper into the beat on net interest income for Bank of America. This comes at a time when yields are pretty low and we are not seeing the same kind of loan growth. I'm looking for the details on loan growth, and we don't have them quite yet. However, we do have the deposit balances exceeded $1 trillion for the first time ever, up 16%, and the consumer investment assets were up 32% to a record $353 billion. How good is this for a bank that really needs the loan growth, those credit card loans that you were talking about that have rates on them of 15%?
They do, and it's really net interest earnings is driven by many things, but it's usually transparent. And I think with the consumer, unlike J.P. Morgan, Bank of America probably had a larger booking in terms of mortgages. Auto loans was down for JPM, maybe stronger today for Bank of America. And then want to take a close look at the credit card business. It seems that for Bank of America, they're well situated and their volumes had to be much better than what we saw yesterday.
Hey, Ken, this is what we're going to do. You're going to sit tight, stay close. We're going to come back to you in the next hour and catch up on another whole host of bank earnings. So we've had J.P. Morgan yesterday. We've had Wells Fargo this morning. We've had Bank of America still to come. Morgan Stanley at 7:30, Citi at 8 a.m. Shanali, before you have to run, let's just have one final word from you. Is there something that ties these three banks together? A broader read yet, or is it still too early?
There's a lot of divergence. We are seeing a much higher efficiency ratio over at Wells Fargo. And, look at the average loans and leases over there. 14% lower in consumer banking, 12% lower in commercial banking. And so where the loan growth is going to come from across the spread is going to be a big question mark. Of course, we've seen that net interest income grow at Bank of America, but, what's happening elsewhere?
Shanali, thank you. Do we see you in the next hour?
You see me very soon.
I look forward to that. Shanali, thank you. 7:30 Eastern Time. Morgan Stanley out with numbers. We'll bring them to you on Bloomberg TV and radio. Tom, Wells Fargo negative about 0.1% in the pre-market. Not a big move. Bank of America up by a little more than 2%. Let's call it 2.5 after a pretty strong rally into these numbers too.
Yeah, to your good question, John, to Shanali, about how are these guys doing? And the answer is, boy, did they learn a lot of lessons 15 years ago. What we're seeing here in this huge natural disaster of a pandemic, and yes, with all the fiscal support and indeed direct aid to the banks, these people are acting off of lessons learned a decade ago.
These banks are doing okay, which begs the question, Tom. The likes of Senator Warren, incredibly frustrated with this Federal Reserve, this chair of this Federal Reserve, calling him a dangerous man. Because of what's happening in the financial sector right now, these banks are doing okay. They did okay last year, they're doing okay now. I guess the question is, do they do okay in bad times? And right now, Tom, looking at the capital reserves of some of these big names, looking at the performance, some of the discipline we've seen over the last 10, 15 years.
The discipline, yes.
Hard to make that argument, isn't it?
Yeah, and what we don't cover here, folks, in a 15-page PowerPoint that comes out when they do earnings is on page 3 or 4, they dive into the social aspects that Senator Warren is concerned about. I don't know if they're good enough for her, but certainly they're addressing hour by hour their social message to their clients, to their customers, and indeed to the nation.
Lisa, the stock is up 2% for Bank of America after a decent run into these results.
One of just the early data points as people from Bloomberg News culled through all of the information is that the average loans and leases in Bank of America's business segment rose to $903 billion. That is only a 1.6% increase. Still seeing that tough sell in terms of new loans, and you do wonder how much that's going to weigh on the performance and the optimism going forward.
Lisa, thank you. The morning heating up just a little bit then. JP Morgan yesterday, Wells Fargo and Bank of America behind us, still to come. Morgan Stanley, 7:30 Eastern time. That's when we expected. I have to be honest, I didn't expect Wells Fargo to come about 5 minutes ago, so who knows. 8 a.m. Eastern time. Citi, thank you, Tom. In the bond market, 152.99 on 10s. In the equity market, up 29, advancing 7/10 of 1%. You need a coffee, sir, after the late night you had in Washington last night. From New York City, another 2 hours of this still to come. We'll catch up with Mohammed Al-Arian next. This is Bloomberg.
They don't know what to say. Again, they can't even fathom that they're out of Afghanistan. They're still in a state of shock and can't believe it.
What we have built through this process is essentially a mechanism for getting oppressed women and girls out of Afghanistan. So we're actually going to circle up and see what resources we have left, to see what options we have left, what mechanisms we have left, and actually look at potentially trying to get more women and girls out of the country as well.
We've been through a lot, us as a team. I know sleepless nights, but you know what? There's nothing more satisfying than knowing that you've saved many lives, and will continue to support these girls on their mission.
is saying it has accelerated innovation in the country, and it's planning to appeal the FTC's decision. What's your take on this, and how do you plan for further scrutinies?
We are going to see what they make and like what changes they are actually bring to this market.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
From New York City.
We're here in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims front.
How are you thinking about those dynamics?
It's not really about whether banks beat on this numbers this quarter. It's more about what's driving the beat on this.
I think we're going to find out that companies still see a lot of top-line growth.
As the COVID problems fade away, I think that's going to be the real catalyst to bring everything back to normal.
Earnings season is going to give us a really good clue of where we're going on some of these supply issues.
It's either inflation or growth, and it looks like we're having a little bit of both.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
There is an equity market lift this morning from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market up 29, Tom. We advanced 6.7% this hour. Morgan Stanley, next hour, Citi.
On the markets, the Gloom Crew gets a pause this morning. It's been a really good tape, John. I'm going to say for 2.5 days. To walk into the Washington studios and see the VIX under 18 is a big deal.
The Doom Crew gets a challenge. Okay, let's run with that this morning. We're up 0.6%. The Transitory Crew increasingly has a bigger challenge on their hands too, Tom, going into year end.
Lagarde making headlines in Washington, the president of the European Central Bank, and this idea, John, of second round, it's a really distressing thing. When they teach second round at the University of Cambridge, Alarian goes nuts and throws chalk at the teacher teaching it. What in God's name is second round? In game theory, it's a different squishy concept. Are we substituting second round for the even squishier transitory?
We'll catch up with the president of Queen's College, Cambridge in just a moment. Tom, that's the story for inflation at the moment. Yesterday, Lisa, I think it's CPI day 2. You can't get away from that number from 8:30 Eastern yesterday.
And if you look at also the Fed meeting minutes, the idea that Federal Reserve officials are planning to potentially end their purchases by the middle of next year really brought forward rate hike expectations. My question this morning is, how much is the market endorsing the idea of sooner rate hikes by the Federal Reserve to potentially tamp down longer-term inflation and get ahead of whatever may be next?
And that curve starts to flatten, which is what we've seen over the last couple of days. We're eating into precious time, so let's keep this one snappy, short, quick. Up 28 on the S&P, advances 0.6%. Yields on 10s in a basis point to 152.64. Euro dollar positive 116 handle, 116.10. And Lisa, an 81 handle on crude again, up by 1.4%, 81.56.
Yeah, the highest level that we've seen going back to 2014, with the idea of the deficit persisting in oil supplies through the end of this year. As you were saying, John, we do have at 7:30 a.m. That's the expectation. Who knows? Morgan Stanley, 8 a.m. Citigroup expected to report earnings. We already got Bank of America and Wells Fargo. To me, the standout aspect here is that Bank of America beat on expectations for net interest income, and that they did see credit card loan growth. This, to me, is interesting, especially given the fact that people are wondering if consumers flush with cash are actually going to start to borrow again. It sounds like, yes, they are, at least on the margin. 11 a.m., we get the U.S. planning to release the crude oil inventories. It's been really messy. However, what has not been messy is the price of oil. It has been up. It is persistent, and we are hearing from the likes of Francisco Blanch over at Bank of America, it could get to $100 a barrel sooner than later, a game changer politically as well as economically for many sectors. And at 8:30 a.m., we get the U.S. September Producer Price Index data. This follows what we saw over in China, where they saw the fastest pace of factory prices going back 26 years. Talk about the T word, transitory. How much can we continue to say transitory if these are persistent? And we're seeing it broaden out with respect to factories, with respect to home prices, with respect to the prices at the pump?
That final part is so important, and Lisa, thank you. At the start of the year, it was a plausible story. The factors behind elevated inflation were temporary, connected to the reopening of this economy. The longer this year goes on, it gets harder to tell that story. Joining us now, a man who needs no introduction. I'm really pleased to say that with us is Mohammed Al-Arian. Mohammed, let's start there. Team Transitory, how much of a challenge are they getting from the recent incoming data?
Massive, John, and thank you for having me. A massive challenge. I think anybody who looks at what's going on will tell you that unless you embrace the analytically meaningless phrase of persistently transitory, which I've heard, persistently transitory, this inflation round is not transitory. We should take it seriously, and central banks should move quickly to contain what could be something that ends up being more than just an inflation problem, but a growth problem.
Mohammed, how small is that window to act, to make that change?
It's there, John, but it's getting smaller. You've heard me say this for the last 5 months. The longer you wait, the harder it is to deliver a orderly adjustment. I think this notion that Andy Haldane introduced last July of a handbrake U-turn, what you want to avoid central banks doing, this handbrake U-turn, is a risk that we should factor in, and indeed is being factored in away from the Fed right now.
Mohammed, one of the more interesting aspects of the price action, we talk about the lift in markets following people bringing forward their expectations for rate hikes, for the end of asset purchases in the middle of next year. Now we are pricing in potentially 2 rate hikes by the end of next year. Is this basically a market endorsement of a more hawkish Fed than has previously been communicated?
Yes, I mean, the market is telling the Fed 2 things. One is, get going with tapering, we can take it. And 2 is, you're not going to be able to separate cleanly tapering from rate hikes. And again, look at the numbers today. Look at PPI in China. This is a very hot inflation environment, and the longer the central banks wait, the greater the risk. And the market realizes this, and it's starting slowly in the fixed income space to price that in.
Mohammed, what would you say to people who argue that there is a self-correcting mechanism here, that higher prices will slow growth, will slow demand, and that you'll actually right-size without the Fed interfering and curtailing growth that needs to hit some sort of acceleration pace so we can get out of the hole?
I will tell them that in theory you're right. In practice, we haven't seen it work too well. It's a very finely balanced, because this is about demand destruction. That argument is about demand destruction. And when you destroy demand, there's a lot of collateral damage and unintended consequences. So in theory, in a textbook, it works fine. In practice, we often overshoot and end up in a recession. So this is not something that I would like to try as someone who cares about the well-being of Americans, and especially those who are lower income, because they get hurt the most in that sort of world.
Mohammed, you joined the International Monetary Fund in 1983. This was back, folks, when the New York Jets were actually good. And you spent a good 15 years there, Dr. Al-Arian. You saw all of the revolution and the different crises, but none like the oddity now. How important is it for the IMF to distance across 19th Street Northwest? Does the IMF need to, in dialogue, break away from the World Bank in the coming weeks and years?
No, on the contrary. You need really good IMF World Bank collaboration going forward. We have a structural issue. The developing countries are particularly vulnerable, and the 2 institutions working together can have a huge impact. What the IMF has to make clear, and has been making clear, is that the data integrity issues aren't about the IMF. No one has raised questions about the IMF's data integrity. This is an issue that relates to doing business report at the World Bank, and the IMF data integrity is as high as it can be.
Right. Within this crisis, are we at the point where marginally we finally give way voting and governance power from the European nations of Bretton Woods over to selected emerging markets, particularly in Asia?
So we have had these governance issues repeatedly. Tom, you and I have been talking about it for decades. The governance and representation of the IMF, while it has evolved, still represents the world of yesterday and not the world of today and tomorrow. And what we're seeing is little pipes being built around the IMF and the World Bank because other institutions are deemed to be more representative. So that is an urgent issue, and Europe has to take the lead on this issue.
Mohammed, we talked about this great divergence this week because of the IMF. Let's talk about that a little bit more from a central bank perspective. We've had interest rate hikes from Chile, a big one in the last 24 hours, I think 125 basis points. Colombia, Mexico, Brazil, South Korea. Mohammed, do you think something big is building here for emerging markets that could spread to DM from EM?
It's funny you should say that because I'm drafting my next FT op-ed, and it will be on that. I think that there's a risk for developing countries that they have the perfect storm. And that means massive cost push inflation imported, especially for commodity importers, lower global growth as China and as the US slow. And then on top of that, the risk of reversal in financial flows. And that's why you're seeing the central banks tighten way before the Fed tightens. So that risk is there. And it's meaningful because I go back not just to your word dispersion, John, but to what Gita Gobinath, the head of research, called dangerous dispersion. You do not want to enter a world in which the low-income countries risk being knocked off the convergence process. So yes, there is that risk, and it's something that we should be keeping an eye on. And it's one of the, unfortunately, underdeveloped themes so far at the fund. I think that the IMF did a great service by introducing this notion of dangerous dispersion, and we should pursue it further.
So, Mohammed, let's pursue it further a little bit more right now. If there's one thing to be focused on, the spillover risk, you know how this works. Often DM doesn't care until it affects DM. What's the one big thing you're focused on right now?
So I'm focused on how capital is responding, because the good thing for markets, and you're seeing it again today, is that the behavioral conditioning of the marketplace has been to buy the dip. It has been an incredibly successful strategy, and we still see residual buying the dip inclination. And the one thing I'm really focusing on is, can we understand the behavioral conditioning of the marketplace and how that's going to evolve? We know the economy. I don't think anybody can doubt that we have an inflation issue, that the Fed in particular is late to this issue, and that we risk a disorderly tightening of policy. I think most people see that as a risk. What we haven't yet understood fully is how the conditioning of markets, the behavioral conditions of market can change.
Mohammed, if the Federal Reserve does, in fact, hike twice come next year, what does that do to emerging markets? How much more pressure does this put on them, given how much they've already had to hike rates to compete?
It depends which one, Lisa, and that's where we're going to see massive differentiation. Some countries have the financial resilience to cope with it and have the policy flexibilities, others don't. And that's a very important message for emerging market investors. So far, they have benefited enormously from simply riding the liquidity wave. We've entered a phase right now where you need a lot more granular analyses, and you need to be the old type emerging market investor, understanding that ultimately you do get contagion, and you've got to be able to differentiate between those who recover quickly and those who constitute non-recoverable mistakes.
Mohammed, we miss you. We miss you. We want you back in America. I understand there might be a free seat at the Federal Reserve soon, so maybe we can work something out. I'm joking. You don't want to go there. I know.
What Tom said about Marmite. I'm in the UK and I love my Marmite.
Do you really?
I do. I love Marmite. It's
Mohammed,
an acquired taste. It
is an acquired taste. You're not. Thank you very much for being with us. Mohammed Al-Arian, thank you very much. Tom Keene, that point there on emerging markets, I think is so important. We're seeing some real hikes over the last several months.
I will say this, John, and I can't believe I'm saying it after 2008 and 2009, Greenspan's famous speech at the IMF, some of the other moments. The tension here is extraordinary, and it all devolves back to an IMF of another time and place and the IMF of the future, which is the emerging markets.
We'll continue that conversation on this program through the week for the IMF World Bank meetings. Your equity market at lift up 31, advancing 0.7%. Morgan Stanley results, 7:30 Eastern, 17 minutes away from New York. This is Bloomberg.
第18条第2項により本院において内閣総理大臣に指名することにこの際暫時休憩いたします。
Watch Bloomberg Surveillance to learn how to look at markets, how to look at trends, and how to look younger.
What do you think, John? Botox, or do I really need to get something done?
I think, Tom, if we just change the style up a little bit.
You think so?
Yeah,
You
drop
look great.
the bow tie. Drop the bow tie.
What,
Drop
skinny
the bow
tie?
Yeah. I always say, this is my line, whenever anyone in America has a go at me about a skinny tie. The older you get, the wider it gets.
Oh, really?
Until it becomes a bow tie.
This is a bow tie.
Until it becomes so fat, you just sort of...
What did you think at the low point of the Greek economic debacle? What were you thinking about to make Greece recover as it has?
Well, Tom, we took over in July 2019 with a very clear mandate to make the economy grow again. We were hit by the pandemic, but we still managed to implement very significant reforms. And I think we used the fiscal room that was available to us to support the real economy. We're very encouraged by the recent data. The economy grew 16.2% in the second quarter of this year. We revised our forecasts upward to 5.9%, and this may be a pessimistic forecast for 2021. We see lots of interest for foreign direct investment by American companies, European companies. We're making big progress in digitizing the state. We have a very ambitious green transition plan. And overall, I think the mood in the country after 10 years of crisis has significantly changed.
How far will the Bloomberg surveillance team go to get the inside story?
The UK will deploy its reserve tanker fleet this afternoon.
There we go.
Tom McKean and I might be part of the reserve fleet that gets deployed.
This is more complex than people think. The steering wheel's on the wrong side of the truck. That's the first thing.
Oh, my God.
Thank you to the gentleman out on Twitter that captured this moment.
Wait, question.
Wonderful.
Who of you has a driver's license?
You don't need that.
The Port of Los Angeles announced today that it's going to begin operating 24 hours a day, 7 days a week. This is across-the-board commitment to going to 24/7. This is a big first step in speeding up the movement of materials and goods through our supply chain. Our goal is not only to get through this immediate bottleneck, but to address the long-standing weaknesses in our transportation supply chain that this pandemic has exposed.
This is the big issue right now. We have a supply-side problem. Wall Street's been talking about it all year. Now it's at the epicenter of the conversation down in Washington, D.C. as well. From New York City this morning, good morning. Tom Keene, Lisa Brammitz and Jonathan Ferro. Your equity market climbing 0.75% on the S&P, up 33 points. You want a single name? Let's pick out Bank of America. Trading revenue better than expected. The investment bank better than expected. The CEO, Brian Moynihan, Tom, saying the following: the economy continued to improve and our businesses regained the organic customer growth momentum we saw before the pandemic. I can hear you laughing from here, Tom, at that organic customer growth momentum line. But here's the bottom line. Stocks up 2.5%, rallied hard into today, and investors so far like what they hear.
Full disclosure, Bank of America with the clearest graphs, the clearest charts. They do a great job on their presentation. And John, the slide on consumer banking, I must admit, it is most impressive.
Things are getting better, Tom. Is that the takeaway, JP, yesterday, Bank of America today?
Yeah, and I know everybody's gloomy out there, and I've been talking up some of the optimism. We got a 2.5-day thing. We'll see if we break out, et cetera. But all I know is Bank of America moves, and, you know, that's a inertial force. What you heard yesterday at the president's speech, as I spoke with Jared Bernstein afterwards, was as the president left the podium, he turned and he walked off to the door, and you heard the rude questions from the press, including two with a Long Island accent. The rude Anne-Marie Horton joins us right now. How are you going to get him to... This is not Trump. This is a habit from Trump. Why do you people berate him when he turns around and walks away?
I completely disagree. We're not berating him. We stand up and politely, you have to shout, right? We're a few feet away.
questions at him. So him and his staff also in the room know what the press
Good.
need answers
What was
on.
your question to the president yesterday as he turned his back on you and exited?
My question was, because yesterday Jennifer Jacobs and I wrote that there was this late night meeting regarding crisis talks, regarding the higher energy prices, what he will do about higher pump prices. And then my second was about his plans for the Federal Reserve, because we know that the vice chair of supervision, his term ended yesterday, and we do not know who's going to be taking on that top job in terms of banking regulation.
I look at this, Amber, I just look at this and I say, an important speech, but who was he speaking to yesterday?
He was trying to explain, and he even started out with a bit of a joke. You're hearing a lot about supply chains. Like, what does that mean to the everyday American? So in pretty much everyday terms, explained what the supply chains are. Now, is the President of the United States responsible for these bottlenecks? This is a pandemic. So much of this is responsible for the robust pickup of the U.S. economy. But he was trying to explain why potentially your toasters or sneakers, whatever you're buying online, is not getting to your door quickly enough. Also, and Jonathan, I think, would understand where the president potentially is coming from, because he was in the United Kingdom last year when the headlines leading up to Christmas was Boris Johnson's a Grinch, he stole Christmas. These are the headlines. President Biden is trying to avoid this Christmas so you can make sure you have all of your presents, etc. I don't know. Hermes bow ties.
And Marie, the headlines this morning have to do with banks and how much they're crushing it. Earnings definitely coming in strong. We're seeing Bank of America absolutely crush it on every count, including even seeing credit card balances rise for the first time during the pandemic. How much will this put in the forefront of the minds in people in D.C. The issue that Senator Warren has been raising about the Fed and regulatory pressure on banks versus that they are the stalwarts during a tumultuous time?
Yeah, we also heard from Senator Brown yesterday about this. The progressives and those who are very much so questioning Powell and Quarles in terms of banking regulation, they're going to be, especially at this moment when we don't have the path for the Fed yet from the White House, they are going to want to make sure that they have hawks in those seats when it comes to banking regulation. Again, we don't know yet exactly what the White House will be doing. Earlier reporting from Bloomberg potentially had this path of putting Governor Brainard in that post, but keeping Powell, potentially a way to give a nod to the progressives but still not changing horse mid-race when it comes to the top spot at the Fed. But also on the Republican side, you hear a lot of questions and anger towards Chair Powell as well. One of them says definitely from Senator Rick Scott. He talks about this all the time. He holds briefings on it, and he says that Powell, he thinks, when I asked him if he thinks he's a dangerous man after what Elizabeth Warren said, he said, I'm not sure if I'd go there, but he should stop buying treasuries.
Interesting. So is the balance of sentiment right now in Washington, D.C., that the Federal Reserve is too dovish more broadly, or is it just that they're angry in general that they have as much power as they do?
It depends who you ask. I think for the most part, you are seeing a little bit of anger on those in the progressives about banking and those on the right in the Republican Party who thinks that there is just too much of buying of treasuries and too much stimulus, and they relate this as well to inflation. But I would say for the most part, Powell does have bipartisan support when you look down the middle from the Democrats and Republicans.
Amory, you mentioned the Grinch, and of course, it felt like my morning this morning. 4 o'clock, wallow in self-pity. 4:30, stare into the abyss.
Green.
And I'm wearing green for the Grinch as well. John, you can be sure I am the Grinch at Christmas. Who's the Grinch for the Democrats right now? I'm thunderstruck down here how little talk I'm really hearing about 2 massive pieces of legislation. Who's the Grinch for the Democrats up on Capitol Hill?
I think I need to be careful with how I answer this question. As a journalist in Washington, I would say...
And I'm not.
I would say potentially people who have created hurdles for the infrastructure path would be the 2 moderate senators. Nothing can get done without them on board, and that is Senator Manchin and Senator Kyrsten Sinema, who there's reporting as well right now that she is in Europe fundraising